All right. Okay. Roll call. Carl England,
Here.
Good.
Jack Prothero,
Here.
Terry Cohe,
Here.
Bruce Nelson is absent. Diane Fladmo,
Here.
Maggie Peterson,
Here.
Mark Barry,
Here.
Jeff Meredith,
Here.
Representative Ken Walsh,
Here.
Senator Ryan Lynch. Do not see him on. All right, but we do have 7 board members present. We have a quorum.
Thank you. So we're going, and we remind everybody that the meeting's being video recorded. Any public comments on issues within the board's jurisdiction? Lindsay, do we have any hands raised?
Nope, nothing online.
None from in the room. We've got minutes from February 16, 17. Is there a motion to approve those minutes?
Move to approve. This is Diane.
Diane, move. Maggie, second. Any discussion? If not, all in favor, say aye.
Aye.
Any opposed? Motion passes unanimously. We have minutes from a March 24th special board meeting. Any additions or corrections? And if not, is there a motion to approve?
So moved.
Jack's moved.
Second.
Terry is second. Any discussion? If not, all in favor, say aye.
Aye.
Any opposed? None. Motion passes unanimously. Let's have some committee reports. Maggie, would you give the audit committee report, please?
It was a very brief meeting. I gave Jack lots of time today for the loan committee, so I'll give a brief summary. Dan did mention that they've automated our financials and they just finished the December quarter ending December. And so the process is moving along in automation, so that's awesome. Julie gave us an update on the Wifley audit. They had an entrance conference with Board of Investments and Wifley on March 4th. They did walkthroughs are scheduled for the week of May 16th, and if those will be virtual. And final testing is scheduled for the week of August 8th. She updated the COOP and related procedures document as required annually. She also mentioned that we will be approving some of the government's policy updates based on a meeting we had back a couple months ago. I think I can't even remember the date, but it'll be sections 20 and 30. And she also spoke to a section 10, one of the items out of section 10 that we'll be discussing during Dan's Executive Director Dan Villa's presentation. And I think we need to, Dan, do we need a motion for the COOP issue? So is there a motion to accept the COOP document as presented?
So moved.
Yeah, is it the, do we accept it or we acknowledge?
We
Do we acknowledge
we
receipt
accept
of
it as presented, just that it's presented.
Oh, okay.
It's supposed to be presented annually to us.
Okay.
There were no major changes. They were all very minor things.
No.
Thank you, Mark. Do I have
Okay,
a
is there a second?
Second.
Diane seconded. Any further discussion? If not, all in favor, say aye.
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 Any opposed? Any opposed? None.
That's my,
Motion passed unanimously. Anything further?
no, Mr. Chairman.
Jack, loan committee.
Loan committee met earlier today. We went over the down payment assistance loan program, new program for us. Over $37 million in funds were reserved in 6 business days. That leverage is around 125 million in economic activity throughout the state of Montana. Program seems to be going well. The distribution throughout the counties is good. The distribution among different lenders is good. So the program has shown tremendous economic success. And I'm pleased how that went. The second thing loan committee looked at was there's a request from the city of Hamilton. They want to borrow from us $3,200,000 to build a new fire station. The total cost of that fire station is approximately $5 million. will be a promise to pay for a 10-year term, the promise to pay from the city of Hamilton. That was approved by loan committee. It is not required that the full board vote on that because of the loan amount. And other than that, that's all we talked about in general. Is there any questions by anybody?
Mr. Chairman, just an update. The city of Hamilton will not be selling the old building. It's on the National Historic Register. They're looking at expanding their library programs once it's open again.
Thank you.
Okay, anything else, Jack?
That's it.
So we don't have a
Mr.
decision.
Chairman, just one question. On the down payment loan assist, is there a cap on the amount of money that you guys have allocated for that? You got the 35, 37 reserved.
The 37 is what the governor's office allocated to us. So
Oh,
they
okay.
said
So it's all used up.
it's all reserved. I think we may have some fall off
Gotcha.
and then we'll move that to round 2.
Sounds good.
Anything else?
Nope.
Okay, anything else? Terry?
The committee discussed what an excellent job the staff has done in the past year and looked at compensation for the next year. And that's all I have to report.
Okay. All right. Comments from pension board members. Maggie?
Okay, we met on last Thursday, April 14th. Just give you I have 3 issues that I thought were important. Cabinet Mountain Cooperative, which I have no idea had no idea where it was, and I can't remember now, adopted the deferred compensation 457 plan. It's great every time to see that different entities are adopting the 457 plan. It's a great vehicle for people to invest in. We appointed William Holohan as the EAC chairperson because Patty Davis, who was formerly that person, retired in February. We updated a policy on the correction of benefits payments in error. It used to be anything under $100 you could just write off if you were having problems collecting it, and the IRS changed their amount to $250, so we changed that, and so we tiered it from that point up to 10,000. We also had presentations by Empower, excuse me, and then our RVK individual, he did a great job, by the way.
Thank you.
Whether or not the EAC had recommended that we adopt the advisory services managed accounts with Empower. We had a long discussion on this, presentations by both, and it was voted that we would not do this at this time because of the fact that we're looking at potentially changing how those funds are invested. If they were to be invested through the Board of Investments, it would be a whole nother ballgame. So this was deferred. No decision was made. So I think those were the big issues.
Okay. We don't have yet appointed somebody from TRS. I know, or I suspect that Diane, you attend those meetings. Is there anything that TRS is doing do you think we need to be aware of?
You know, I don't attend the meetings,
Oh, okay.
so I can't report, but I certainly can get you a report for May.
All right. That'd be great. Okay.
Mr. Chair, do we have any word when someone will be appointed? Isn't it now almost 6 months since we've had a representative?
I can report one other thing. I think May 12th, we're getting the experience studies
Yes, you got to make
for TRS and
both come
both
in.
of them together. So we'll have
Okay.
to report at the May meeting.
All right.
Who will get that report?
Pardon me?
Who's gonna get that report, the experience?
Empira and TRS. It's being done together now. It used to be done separately at different times, and we've kind of coordinated it because it makes so much sense now.
All right. I guess no news is good news from TRS. I would call it that way. Representative Walsh, any words of wisdom from the legislature?
Nope, I don't think so.
Okay.
There is no special session, so
Any comments that you'd like us to?
I think that's good. So,
No special session.
yeah.
Okay.
Thank you.
Well, okay. I'll leave it at that. not get myself into trouble.
For me either.
All right, so I know the agenda says we're gonna go to the capital market assumption, but we moved that around a little bit. We'll do Dan. Tab 2, and hear from the executive director. report. If that's okay with everybody?
So you have the new monthly snapshot on your desk. For the most recent month, we have data. You have a memo in the packet on benchmarks. Happy to delve into that in more detail if you'd like. You do have decisions for you to make. We did the reviews on sections 20, 30, and then the revision of policy 10-217. I'm going to have Peg, would you walk us through the changes to 217, please? Very last page. Page in tab 2.
Yes. So when we were reviewing and going through the policy manual, there were 2 policies in section 30 that were one sentence and referred back to policy 217, 10-217. So we just moved those sentences into 217, and then that will allow us to eliminate the 2 policies out of tab 30.
And remind me again, where the 2 sentences are.
I'm sorry, I was not on the page, so if you'll give me a second to get there.
Okay. Do you remember?
D&E.
Is it D and E?
Organization of investment.
It was 2 of those weird policies that we had that sort of got thrown in and said, do this under the authority of 217. So when we were reviewing it, it's like, well,
Yes.
let's just put it in 217.
For those that.
It was policy 30.231 and 30.232.
Yeah.
Right.
It's been read.
And they became D and E? Is that right?
So if you go to 32, so if you go back a few pages. So you'll see 232, it's all struck.
30.
So board staff may not transact business with investment managers without the specific approval.
Okay.
So we just struck those 2 policies and then inserted that language into 217.
All right, so how do we want to do these? Do we need to approve them? We don't need to approve them.
These are all the changes that we talked about when we did
Yes.
the first review. So can we just approve it as a bundle? I mean, is everybody comfortable with that?
Yes.
Then I would move approval of the revised policies as contained in our book.
So it's sections 20 and 30
And revised 217.
and revised policy 10.217.
I'd second that.
Okay. Maggie did all the mays and shalls and. Yeah. Anything else from anybody? That was a long session. When did we do?
You know,
What was the
I've
day of that?
suppressed that.
You
memory.
suppressed it?
It was
March
early-
3rd.
March, yeah.
Right,
We have another one, May 4th,
May 4th.
to do the in-state loan program, section 70, and begin, what was the other one?
10 and 70, wasn't it?
10, the board itself's policies.
Okay. Well, anyway, there's a motion on the, and a second. All in favor, say aye. Aye. Any
Aye.
opposed? Any opposed? None? Motion passes unanimously.
We're not having any discussion with benchmarks. Basically, there's no change to the benchmarks, Dan.
I love samurai.
Abby is okay with all that. You're gonna learn being on the board.
Well, now, wait a minute, because I think he just set the record for the shortest discussion ever. I think Mark deserves a great deal of credit for that.
Sign of exhaustion.
Right. You want to, before you introduce new staff?
Do we have to approve those benchmarks or that's just?
They've already been approved within the policies that
Right.
are existing. And there's no change.
You going through all the policies.
Does anybody, we're on the 4th, we're gonna have another one of those meetings where we're going through policies. Did that work all right for everybody, the way we did it before?
I was remote and it was hard doing that remotely. So I'll be in person this next time. But anyway, I think it's necessary and it seemed
Okay.
to work, although it was hard for me being remote to do that.
Okay,
It's at 10 o'clock, is that correct? 10 till noon?
okay. All right. Dan, you want to go back to,
You bet. Introduction of new staff. We'll start with a familiar face who is now a permanent employee. Sam Holman started with us 2 years ago as an intern. She's on the thing. She's actually taking finals this week.
Oh,
So Sam joined us 2 years ago as an intern. We didn't scare her off, so she has applied for a vacant accounting position and was the successful applicant. So Sam, what did I miss?
Oh, not much. I'm happy to be a permanent member of the team, though.
well, welcome, Sam.
Thank you.
Welcome back, or welcome permanently. Welcome
Welcome to accruing a pension and leave.
Yeah, but don't take the lead. All right,
Second team member, new, Matt Hoffman joined us in the operations team a couple of days ago, weeks, 1 week ago.
it just seems like.
Yes. So I'll let Matt introduce himself.
So Matt Hoffman, I'm originally from Helena, actually, went to school down in Bozeman.
Matt.
Yeah.
Positive.
Everybody makes some mistakes.
Some of us think it's a good thing, but
Depends on who you ask, I guess. Joined a couple weeks ago, spent a couple of years out in DC as a consultant and moved back with the craziness of COVID. So
Well, welcome back and welcome to the board, and we look forward to hearing more from you in the future.
within 1 week, he was already conducting his first training for the rest of the staff.
There we
So
go.
He's doing well.
There we go.
What did you do as a consultant?
mainly federal contracting with Treasury Department, USDA, Ginnie Mae.
Some agencies he can't talk about in Canada.
All right, well, nice to meet you.
Nice to meet you all.
Okay, anything else?
Nothing else from me. We're still about a half hour ahead.
Now we're a half hour ahead.
Well, originally, when Jim was traveling with partner, there was a flight, so we rearranged the agenda to make the flight. Well, now Jim's here by himself, so it made sense to put Jim and John together for the full capital market assumptions. Is Thomas on?
I'm here.
Do you
I'm
want to,
here.
should we jump into new commits? That'll fill a half hour
Yeah.
On tab 6,
on tab 6.
what about Michael and Jason? Are they on?
I'll go alert them if they're not.
Jason's right there. I see Mike's on.
Get ready.
Thomas,
I'll be
when do you
there.
launch?
Yeah, I'll be there in a second. I'll grab Michael and who else I see on the way over.
Jason, you want to come in? You can be first if you're first here. It's a race to the courthouse steps.
Representative Walsh, I seem to have lost all control. Can you help me here?
I apologize for Erin not being able to be here. She had an accident and her doctor said that she ended up with a concussion and ended up being told by her doctor that she had to take 7 days of doing nothing. So hence I'm here without adult supervision. So there's no telling what might come out of my mouth.
So I was wondering how many concussions you've had.
Well, there have been some. Let's just say I don't wear a helmet when I'm skiing, kayaking, biking, you name it.
Yeah, they're coming. Really sure good recovery. Those vehicles can be
Oh, yeah. They can linger on. I don't. Sound like he's been from experience.
Yeah, personal. Kick it off or?
Yep. A lot of people know. I didn't check.
Mr. Chair, are you ready for?
What, am I ready for who? For Thomas?
I'm just gonna kick it off since everybody else is.
Yeah. Well, Thomas, I've lost all control, so you might as well say.
I was gonna say good afternoon, but it's still before lunch, so good morning, Mr. Chairman, members of the board.
Good morning.
I'll kick it off with one or only new commitment in the real estate program. That was Angela Gordon Realty Value Fund 11. As you can see in the board brief, a very long-standing relationship with the board. We've been investing with Angela Gordon since 2007, so almost 15 years. Serially invested. This will be our 8th commitment. You can see here $50 million in line with our average check sizes currently. Angela Gordon will continue the very successful strategy of value add non-core investments. So what this means is really we're looking for properties that have a little bit of a, I don't want to call it distress, but there may be some repositioning going on. We might have to do some reconfiguration of the building, some updating and those type of things to be able to fully lease these buildings and make some money there. I wanted to highlight that we were able to take advantage of a 50 basis points fee discount for our first closers due to our ability to act nimble and quickly. Always wanted to highlight that. Other than that, I'm going to open it up to any questions that the board might have.
They've had a great success. I like those IRRs. This real
So do we.
high level. Why are they so successful?
Why are they so successful? For one, they have been doing it for a very, very long time. You can see here, founded in the late 80s. Together, partnership. It's a very successful team and always put an emphasis on being the people that are not afraid of some deals that, as I mentioned, have some hair on it or a little bit of difficulty, so they don't shy away from that. Very conservative in terms of leverage use as well, so that protected them on the downside significantly in years or time periods when things did not go as well. So that combination of the two factors really is what kept Angela Gordon very successful. And yeah, as you see here, even the current team that's working on Fund 11 has been working together for over a decade. So there's a very strong cultural continuation at the firm.
Thank you.
Mr. Chair, this is sort of a general question. There's been a lot of press about private equity firms buying up single family and multifamily homes and driving homeowners out of the market and then causing rents to go up. I was worried that we may be part of the problem there. Do we have much exposure in that type of area?
There is potential for exposure there. And Angela Gordon, I am not aware that they're going in the single family rental space, but it is a topic of discussion across the entire real estate platform. I'd have to dig a little bit deeper. I don't have top of my head if we already have exposure there, but I could see that being in the portfolio at some point.
We have some exposure to that, Terry, but there are, it's been a hot space. There's been a lot of individual funds that are in that space, that's what that fund does. We have avoided that.
Good.
We have, for some of the reasons that you mentioned, we do have some managers where they have, similar to an Angelo Gordon, where they may have, a variety of areas where they would invest in. And so I don't have numbers again off the top of my head. It's pretty small, but we do have some managers that are in that space. It's not the entire portfolio or something that they have, but they may have, pieces of it. We can get you more specific numbers, but
I'm not worried. It's just, I'm glad we're aware of the issue and trying to not pursue that because, of course, thank you.
And are we not pursuing it?
I would say we're not pursuing it. I mean, Ethan and I have talked about it quite a lot. Don't think there's a great long-term opportunity there. It feels, and for some of the reasons that Terry noted, it doesn't feel quite right. The returns that you're getting there, I would say aren't really any better than other places we can play. It feels a little like dig into the CapEx that's needed for some of those types of investments. It feels a little more health space type stuff where we made an effort to avoid. We just think there's just better areas that we're more interested in. And so lots of reasons there, I guess, but to answer your question, an investment decision, not driven necessarily by, oh, we're going to get, a lot of pressure here one way or another, but certainly that's not a non-factor either.
Yes.
So on the LPAC membership, it says observer, does that mean no? I mean, what does it mean? Because it's usually yes or no,
You're
so.
officially in the room when the LPAC meets or on the Zoom call, whatever, we just simply don't have a vote.
No vote.
That's what that means, yeah. But we're getting the same information. It's just if there's a vote.
Anything else from anybody? Yes.
So primarily US with maximum 20%, international, that's a hard number, 20%.
Yeah, there's a limit. And there's also, if you see in the title of the board brief, we are invested in the US sleeve only. The overall strategy has the latitude to go up to 20% outside of the US, primarily Europe. But
This is US.
we elected actively to be in the US.
Are all the others US or some?
Yes, as far as I'm aware, yes. The prior fund 10 for sure, and all the other ones. Then there may be some Europe exposure. I'd have to dig in.
It would be small.
It would be very small. It's traditionally in that 10-15%.
I'm sorry, I don't understand.
Go ahead.
The fund itself, AG Realty Value Fund 11 can do 20% international.
Correct.
But our money can only be used
In the US.
in the US.
It's a parallel vehicle, if you will, or.
So on the waterfall type, how does that work?
It's, we're not
European
the only
waterfall.
investors that selected to be in the US only. So there's essentially, it's a parallel fund that Angelo Gordon is running.
So it's kind of a fund within a fund?
Within the fund.
Okay. Okay. Does the international investments returns, do they factor into the waterfall?
No.
Oh, okay. So it really is like a separate fund.
Correct.
I got it. Yeah. Sounded pretty knowledgeable, didn't it?
All good. Any questions?
Thank you.
Thanks. I'll hand it over.
All right, Michael, are you up next?
I got it.
Looks like we got a couple from you.
Sumeru Equity
Subaru and Barrett.
Fund 4. This is an existing relationship, so a re-up for us. What they do is they are a sector-focused buyout fund. They focus on software and technology. There was a underexposure to technology in our buyout portfolio. We have not historically had an ongoing relationship with a technology software focused buyout manager. And so, we canvassed the market and decided to go with Sumro. Why do we like them? I think it's a very strong tenured team. There's 8 partners. 4 of them are more focused on the investment side. 4 are more focused on the operating side. They have a background from very engineering focused background. They come from IBM, Qualcomm, Adobe. On the investment side, they come from Goldman Sachs. The managing partner was the head of Lehman's Technology iBanking Group. So strong pedigree here on the team side. We also like the fund size. They're raising $1 billion, which is comparatively small compared to some of their peers. The largest, 3-5 groups have raised $50 to $60 billion in their funds. So $10 to $20 billion funds in the technology space. These guys have decided to stay small and focus on what they've done well historically. And so, we think there is a lot of froth in the technology and software space. You see a lot of headlines there, multi-billion-dollar deals. We think Sumro will kind of ride that tailwind because they are operating at a lower market compared to some of their mid-market, large market peers. And that's a theme you've seen in our portfolio historically, trending towards lower mid-market type of deals. I'll pause there for any questions.
Questions? Anything? Okay, next one is Veritas.
Veritas Fund 8, longtime relationship. We've been investors since Fund 4. They focus on really the end user being government. That's been their niche and edge in the market. I think the performance has been excellent. One of the best performing managers in our portfolio, and I think also very well known as one of the best performing managers in the market broadly.
So 81% is good.
I think the biggest question here is, how are they going to do going forward? The fund size target is $8.5 billion. They'll probably raise over $10 billion. I don't think we are dogmatic about fund size. It's really about the opportunity set and their ability to generate returns in their respective markets. I think what pushed us over our concerns and some of the flags here is they had one of the largest exits in the market. It was $1 billion investment, 1 point something, I forget, and it returned 10 times their money. It was a $17 billion exit. So they have proved that they can buy billion-dollar companies and exit at tens of billions of dollars. And so, an $8 to $10 billion fund is not too large when you're looking at the opportunity set here. And so that's what got us comfortable with the re-up here. I think historic performance is good, but that's not what we underwrite to. We're thinking about forward performance and where the team is going and the fund size and how that matches with the overall opportunity set. So we're re-upped here for $60 million.
Question, I know you don't look at the historical things as much like you just said, but can you talk about how come they're so successful?
I think it's first and foremost, their historic success has come as a product of them focusing on the sector, government-related services, and that being the end user. Ramsey, the head of the firm, has one of the highest security clearances. And so, historically, other buyout firms cannot compete because they don't have the information and they have not been focused on the government sector. I think there are newer firms in market now, and so there's a small handful focused on this sector, but they don't quite have the expertise, network, and history compared to Veritas. Veritas is clear in a way the leader in this space over the last decade or two. But there are some smaller shops. We've decided not to go with those firms because Veritas has done very well. It's an existing relationship, and we expect they'll continue to do well, even though they've gone upmarket and done bigger and bigger deals. But they've still shown a track record of success in doing bigger deals.
Anything else? Yeah, Megan.
Quick question. So on the waterfall type, it's deal by deal. I don't know that I've seen that, but is there an advantage or disadvantage to that over the European? Just reading it.
Yes and no. Double-edged sword. I would say the majority of the best buyout managers have a deal by deal waterfall. It's beneficial to them. And so as a function, Sumero, other buyout managers in our portfolio, well-established buyout managers will have deal by deal carry. So they get our deal by deal waterfall, which means they get the carry earlier. They would probably argue that this is the model that they need to attract the best talent, that they need to pay out their younger partners and the mid-stack of employees because they could go to technology companies, they can go to other buyout firms. That's usually their argument for deal by deal carry or deal by deal waterfall and subsequent carry.
Thank you.
Anything else?
Is the target investment size up to 3 billion? Is this the largest? Would that be kind of the largest target that we have? Seems quite high compared to where we're at right now.
It's on the higher end. I would characterize Veritas as a large size buyout manager here. We historically haven't done a lot of that. Most of our relationships are lower mid-market or mid-market. And so most of the deals you would see in Fortune or CNN were generally not in those kind of deals. So this is definitely on the large end of the market where their deals are probably in the news because they're large deals.
Okay, so am I misreading that? I guess I was under the assumption that the target investment size related to our investment
No,
into that. Okay, so that's
total
okay,
deal
so I was
size.
carrying that over from Thomas's 25 to 50 per investment. So that's the total investment of which we would only be $60 million participant.
Of a $10 billion fund.
Anything else? Have we, or is our 4 and 5 and 6, or 4 and 5 paid off? Are we still in 4 and 5?
Not sure. I'd have to get back to you. I think they are substantially returned, but I don't know the exact number off the top of my head.
I'm just curious because with, I mean, you total everything up, we got 170 million invested with these guys. And I wonder your thoughts on concentration or something.
I think it's not one of the highest concentrations in the
Really?
portfolio.
Okay.
Fund 4 is a 2010 fund, and so it's over a decade old. And so there might be a stub piece. So
Okay.
the older exposures, Fund 4 should be mostly deployed and returned. Fund 5 might be some on the ground. But Veritas is not one of our larger overall exposures because they've returned and had so much success. They've returned a lot of this capital.
Has the investment window passed on the old funds?
Fund 4, 5, and most likely 6.
So what that means is what you see is what you get. There's not going to be a new surprise, a new investment.
Right. Okay. Oh, thanks, Michael.
Thanks, everyone.
Yeah.
Nice to see everyone in person.
Nice to see you in person. You look remarkably like you Steve.
Yes, sir. Pleasure to be with you all, also in person. I'm going to talk about a change in managers that we made in the international small cap space. We had DFA there for quite a long period of time, but had kind of become disenchanted with their process. They had made some change to they were a quantitative type manager and had made some additions to their process that really seemed to be counterproductive. And, we didn't want to stay in that any longer. So we had started looking last year for a replacement. And the manager that we ended up coming up with was an Acadian small cap product. Now, you probably have heard the name Acadian for a long time, since we've had them as a large cap manager since 2006. But we did all the same level of due diligence that we would do for any manager, whether they were, a manager that we had just met or a manager that we had known for a long period of time. Ultimately, we decided to go with them. In February, we conducted over about a week and a half period, a 3 tranche transition from the DFA fund, which had been a commingled fund, whereas this is a separate account. So we got the cash from them in 3 separate tranches and transferred it over to Acadian. Again, being a separate account, it's a little more complicated because we have to open the individual countries. We have to have sub-custodial relationships in each of the countries that they want to invest in. So it takes a little while to get that all set up. Whereas with a commingled fund, that's the manager's problem. But we prefer to have a separate account for various reasons. We can specify our own investment guidelines. We get daily visibility into what our holdings are, which are things that we can't do with a separate account, with a commingled fund. So we ended up going in this direction. Acadian is also a quantitative manager. In our assessment, as far as quantitative managers goes, they do a pretty good job of explaining their process, which essentially is attempting to, as many managers do, try to take advantage of investor biases and things of that nature that other managers, that other investors do, but they try to take these qualitative factors and make them into quantitative numbers in areas such as valuation, quality, technical factors like momentum, things of that nature. So they have 70 or so factors that are grouped into those kind of larger areas. When we do reviews with them, they actually put this up on the screen for us and kind of show, here's how all these different factors work together and how they perform over time. So again, as far as a quant manager goes, it's less of a black box than some are, I guess I would say. Obviously they're not going to reveal to us every detail of their secret sauce, but at least we're kind of able to see how it goes together. The large cap fund that we have with them already has done very well over a long period of time, and we are optimistic based on our experience with them that this small cap product will do very well for us over time as well. So I'm happy to take any questions that anybody might have.
Go ahead.
When you have all those figures and they're proprietary, does that make it harder for us to get with a firm like this, or is that pretty standard? Because I know they're very cautious on giving out that information.
Yeah, and I guess I would say, we don't have, in the grand scheme of things, a lot of quantitative managers. I wouldn't say that it's necessarily a higher bar for us to hire one of those, but we do prefer, ones like this. As long as I think as, even with a fundamental manager, we're not going to know, exactly what goes on in the portfolio manager's mind when they're coming up with what they come up with. So, they can, even with a fundamental manager, they can explain our process to it, but in some sense, we're never going to know exactly what goes into it, even with a fundamental manager. And I guess I would say with a quant manager, it's similar. It's just that they're taking their brain and putting it into equations in a computer to do that for them so they can keep track of a larger, have the computer keep track of a larger number of factors or interrelationships between those factors that the human brain, wise as it might be, can't do at that level. But I guess I would say whether it's the computer brain or the human brain in the final analysis, they can explain how they go about it, but there's always going to be things that we don't fully understand, whether it's quantitative or
So
fundamental.
Jack, were you asking, is it harder for us, a higher hurdle for us to invest in the fund or harder to get access to the fund like that?
Both, I guess.
Both. The access question would be, we've had a longstanding relationship with Acadian, and that led to us getting in the strategy. It was essentially close to being closed.
Yeah. And then the old fund, that was one of the problems you had is they changed their equations or. I mean,
Yeah, they added some additional factors to it. And, that's a case with DFA's case, I guess I would say, again, we understood kind of what the broad parameters are, but I would say, I feel, having studied both of these managers for a while, I have a better sense of how the process works and what the things are that go into the brew for Acadian than I did for DFA. We understand broadly what the changes were that they made. And it just, we could see that the output wasn't obviously what they or we were hoping for.
I think we had a couple different funds with them.
We did.
Out of them.
In fact, we had them for a total of 3 funds. The longest running one that we had was the domestic one, but it went away when we went to all passive. What we had on the international side, the vast majority of our managers, as in this case with this fund, combined both developed and emerging markets in one fund. That way we don't have to hire twice as many managers, among other things. DFA did not have a single product that combined both developed and international markets, so we had separate funds, but in a sense, it was, being treated in the same sense that the way we approached it. But yeah, we are fully out of all 3 of those at this point.
Yeah, I wouldn't consider DFA, at least in my mind, I would consider DFA a quantitative manager. Certainly very different from what Acadian does. DFA has a few large factor tilts, and that's about it. I think too that when we were looking at the opportunity sets, there might have been some other issues too in terms of the relationship we had. And I think, as I mentioned at the last board meeting, I think we had a better opportunity. And
So was DFA hired as a quant manager and then through the evolution, we came to learn that they weren't really, or?
no, we hired them as a manager
Okay,
based on
right.
their process, their philosophy.
And then that changed and the results.
Well,
weren't great.
The philosophy didn't really change, but they added a few things, and certainly they typically would have a value tilt, which for several years did not work. And that would be the case with any value manager from 17 to 20. But I would say that, not that we have a bias for or against any type of quantitative or systematic, because they're using fundamental factors.
Right.
They're a fundamental manager, they're just using a different process to do it. For us to hire a new manager, we have to understand the process. And in that respect, hiring a quantitative manager kind of has a higher bar for understanding. And in terms of the proprietary signals, they could give us that information. I don't think it'd make a bit of the sense to anybody without a PhD in math. It's like, what would I do with it? I would sell it to somebody else who understand it, but no, I would never do that.
You're not gonna run it on your phone and for yourself?
Carl might want that.
I don't think my phone would have the power to do all the computing that's required for that. But,
When we go to visit these guys in Boston, they have entire walls that are effectively whiteboards that have equations and computer code and stuff written on them. So
And I think too, in terms of understanding and the process, I think they have done an excellent job in terms of the interface, as Steve mentioned, that when we either on a call or when in person, they can pull up their system that they developed a few years ago that has all 72 of their signals, how they performed, and they can explain that and show it visually too in charts and things that much more helpful for us understanding than just words.
Terry?
Two questions.
Yeah.
Was part of the question, Jack, because we're a public fund and that quant wouldn't, that we have to be more open than private? Is that kind of what, or is that not an issue at all?
Again, I wouldn't,
No.
I don't think that that's ever been an issue from manager selection standpoint. I would not view that as having
And
been a
then
problem.
second question, going to a separate fund, and I can understand lots of reasons for that. That made me think of securities lending. Do we do securities lending on the international small cap arena?
Yeah.
Is that? It just seems that could be more risky than some areas, or does the size and international not make a difference in securities lending?
No, I think the collateral pool you're investing in determines a lot of the risk, but the demand for from investors to short stocks may be higher and certainly may be more lucrative from the securities lending side in terms of generating revenue and fees.
Yeah, I definitely concur with that. A lot of the risk associated with securities lending is in your policies, your collateral policy, pool policies, as opposed to the particular subset of equity. That can be quite volatile, and in fact, that's where the highest returns are to sec lending typically, because that's where the short world operates.
So is that a factor in deciding to go to separate, or you had made that decision anyway?
This was, that was not a huge factor. It would be, and we'll talk about this later today when you do the domestic equities asset class review, that when you invest in a commingled fund, the securities lending arrangement is with the manager and the fund custodian. With a separate account, the securities lending arrangement is with us and our custodian. Typically, the arrangement we get for a separate account is much more favorable than it is in a commingled fund.
Thank you.
Okay, anything else? Thank you,
Thank you.
gentlemen.
Thanks.
Oh, great. Yep. Thank you. We will be back at 1.
I believe so.
Great.
Yes.
Yeah, we'll be back at 1.
We're all set.
To go back on, back to work. And our defined contribution, deferred compensation, education. Gentlemen,
Mr. Chairman.
welcome
members of the board,
again.
Thank you. Thank you
Always
for
a
the
pleasure
invite.
to see you.
Thank you. It's a pleasure to be here with you today. Director Villa, thank you again for the invite. I'm Dory Schwinden, Executive Director for the Retirement Systems at Ampera. We had a board meeting last week and had, I think, a robust discussion about this issue, along with some other DC 457 things that had come out of our Employee Investment Advisory Council. Ian Bray from RBK attended that meeting in person, and he gave us a lot, I think, valuable insight and answered a lot of questions for our board. We've got some plans for the future, and I think what I'd like to do is to turn it over to Deputy Director Holohan to describe what our intentions are. I think with Mr. Bray's expertise and background there, we've kind of set a tentative timeline of getting this accomplished between 6 months and a year from now, given that we've got an experience study coming up, annual valuation, and a legislative session ahead. I think my personal goal would be somewhere before a year, calendar year.
From this date, from this time period,
Pardon me, Mark?
from this time period.
Yes.
Okay.
Mr. Chair, members of the board, Bill Hollihan, Deputy Director at Impera. I think what is clear is that our boards have kind of been talking separately. Staff has been talking separately. And so the idea here is to let's all get together, staff from Impera, BOI, reps from RVK on May 4th is the tentative date we've scheduled, to have a working session where we can try and hammer out a proposal, which would include a timeline for achieving menu simplification if necessary, and the lowering of fees within each plan's investment portfolio through the potential of BOI, assuming the investment management function of both DC and 457. I think that's the next step. The idea then would be to bring that proposal to our board first for an action item, and then subsequently to your board, I would presume, to take action on that as well, so that we could have a working plan to attack this going forward.
Okay. So menu simplification, would that be something that you guys envision you would do before?
Well, I think that discussion can take place at the same time we're coming together with BOI as this working group to examine the menu. I think menu simplification is certainly something that our board president has said is one of the top things on her agenda. So we do want to, I think that can be done at the same time that we're having these discussions. That would be my take.
I think we have decision points. June is your board meeting, right?
Correct.
Yeah, June decision points. Backing up from that, the path to take is develop, what needs to be done, menu simplification, fee reduction, frankly, manager review. There are some in there that probably need to go away.
I thought that was meant, thought that was what was meant by menus.
So I view menu simplification as a two-prong. One, are the managers the right managers? And two, are there too many managers? And we need to narrow that menu down.
Whose decision is that?
That's part of what we've got to discuss is, it would be our investment assertion that if we're going to do this, the right people to make those decisions are the public markets teams here doing a due diligence on all of those firms and then bringing those recommendations forward. But that's the Star Wars meeting, may the fourth be with you. But then we would bring that conversation and those decision points first to Impera because it's theirs to initiate, and then to BOI as it's ours to respond to.
Go ahead.
No, keep going. Well, I'll just ask. So I'm still unclear, and I think it's not known, but you will have that meeting. The staff will presumably, if everyone agrees to it, at that meeting, do this analysis and so on. So then before it goes to the Impera board and then subsequently to us, will the decision be made about the menu simplification?
No.
Or, okay, that's the part I didn't quite understand.
No, I think more we're talking about what we believe needs to be done and the logistics behind it. I mean, this will be the conversation about who maintains the contract with the custodian. What's the notification provisions that we will need to follow for manager changes in line with their member notification?
There's going to be a ton of member communications that are going to have to take place before any of those fund lineup moves would be right.
Because there's still the existing committee that has authority at this point, right?
We have an employee investment advisory council.
So they're advisory.
That is an advisory council that can make recommendations to our board. They are non-binding recommendations.
So this point.
But so the menu, maybe I'm using the wrong word. The options that employees have invest. That's something that's been approved by your board. Is that
That's
right?
correct.
By your board,
Right, not the advisory, by the.
well, it's come to them through the advisory.
Recommendations would come from the advisory council and they would be approved if we were to put a fund on probation, remove it, add a fund, and then the full board does approve those decisions. Yes.
So does coming out of May 4th, something that says, okay, here's step 1, here's step 2, here's step 3, here's step 4, here's step 5. And then, as I understand it, once your board sees that, then they would have, what they're gonna do in June is say yes or no, we want to ask the Board of Investments to follow along, well, to take over the investment side of this.
Correct.
Does the advisory committee go away?
Something we have to talk about. We have to talk about that. It's a creature of statute right now. It can go away, it cannot go away, I suppose.
And there's different interpretations of what that statute says.
I think that's correct too.
Really
Yes.
serious.
Yeah.
So it might just function differently than it is now.
Yes. And I think those details would probably be a portion of the MOU that we would eventually get developed. You know, to cement that relationship between the Impera board and this board.
And I want to just remind everybody, I shouldn't have to, but I am. It's a board of lay people.
Yeah.
They're not investment experts. We have the investment experts right here in this third floor space. And that's why some of us, since the day I came on the board, I said, why aren't we doing this? So
So to get to the May 4th meeting, is there anything that you need us to do now to make that meeting work? I mean, as the board here, I mean, do you have anything in mind, Dan? Or
Provide your
what we
expert
should be
staff
doing?
at a time when we can all sit down in one room and hammer this thing out.
So do you want any, not really a vote, but I mean, approval that you would take some staff time to work on this, or what do you need from us?
Right now, nothing.
Oh, we're good at that.
Try to lean in on your strengths.
Like with the fixed income team.
I think right now it's a little bit of exploratory work on both of our sides of, okay, John, we have the current menu, we have the performance of the current menu, we have our lineup versus their lineup. We've already started doing fee comparisons. You'll be shocked and amazed to know that our $25 billion in assets gets a little better fee than the $1 billion in assets on the other side. So we think there's an early quick win, I guess I'll put it, for the beneficiaries in these programs, that we can get that lined out. We've got some homework to do. The investment team needs to look at, what does simplification look like from an administrative standpoint? Are we talking white label? Are we talking just fewer options? Those are all things that we'll need them looking at. Reporting is going to be a thing that will fall on both our side and their side with RBK's input. How is performance tracked? How do we make those decisions? The things that we'll need from them is, how much lead time do you need between us making a decision and being able to execute on that decision? And what are the roadblocks to that? Because again, it's not us dealing with a peer board, it's us and a peer board and an individual vested in member who has distinct rights.
And
Go
down the
ahead.
road, as things change, potential investments, communicating that, who's going to do that? I'm sure it's going to be us.
It will be
You're
us.
on board.
We're not touching.
What kind of, yeah, but what kind of a timeline do we need for that? So those are all the things you guys are going to talk about right at your main meetings.
Yes, and then there's also the record keeper aspect of it, that we have to iron out the details about the actual record keeper, which, has been Empower Retirement. And I mean, you guys don't want to do that. That's not something that you want to be doing. So we'll continue to have our fingers in that role as well.
So is there any individual or groups or that would be pushing back against doing this? I mean, is there, we might, I mean, that might be unknowable, or maybe you do know that, but is there opposition that we have to be aware of or things like that?
Go ahead.
We're not aware of any opposition at this point in time. I think anytime there's a lineup change, and Jim, I'm sure you can speak to this as well, you're gonna have some noise from some participants, but if documented correctly, mapping's done correctly, I think you alleviate any legal risk concerns.
Jim,
Yeah,
we talked in, some of us talked in Portland about this subject, and it seemed to me that what we heard from a very high level from your folks was this not, it's not, I don't know what the word's common, but it certainly isn't. I mean, it happens multiple places that that the people who are investing on a defined benefit plan are also making investments decisions for a defined contribution plan. But have you ever, or do you know, have you guys ever advised people in a transition like this?
the answer is yes. Just a couple of comments. One is that I think it's important to distinguish between the structure of the ongoing relationship between the two boards. The menu simplification is simply the task at hand. But over time, there'll be other tasks. I mean, there always are in the investment world. And so you mentioned the word MOU. That's very common when two organizations agree to cooperate. The MOU sets the terms of that cooperation. And so that's part, I think, of the discussion on the 4th. And I'll be there, and Ian from your side will be there, and we'll probably have one of our head of Defined Contribution Solutions Group, who ran both a DB and a DC plan for many years at Amgen. So she's very familiar with this. So, and there are three structures that we observe in this sort of relationship. One is complete delegation to a private party. It's called 338 under federal statute. Some corporations do that, a few public entities do that, and essentially it's outsourcing all of the investment to essentially a money manager who runs the investment side of the program. In this case, that would be the board potentially. So complete delegation is one. There's another structure that is what we would call integrated, and that is where a single board has both the DB side and the DC side, but they're actually running two programs separately, but they tree up to the same board. CalPERS is structured that way. We've done many consulting projects for the DC side of CalPERS. They have their own organization, and there's interaction between the two, such as you envision here, but they take place within the larger organization. And then there's the two board structure, which is what is on the table here in Montana. We've seen examples of that as well. So yes, Carl, to your point, we've seen all three of those. And a transition plan like this really is walking through, to use again Dory's phrase, the MOU, and saying who's responsible for what and on what time frame, because it not only applies to menu simplification, which is kind of a big task that's on the table right now, but you might look ahead to 2023, 24, 25, and there may be other things that your board wants done, or that this board says you should be thinking about because we think we can get you lower fees, or we think that the manager structure, like a white label, needs to be revised, or whatever the case might be. And those would be decided under this MOU. The menu simplification thing is a task at hand. And I know that your board has done a lot of work on it because I've seen all the presentations.
Yeah.
So the groundwork has been laid a lot for what your board thinks about it. But to my knowledge, you haven't actually done any of it. You essentially tabled it because that might be done, executed for you over here. Is that responsive enough, Carl?
Yeah, I mean, I get it. You feel comfortable giving both boards advice as to how to do this, because you worked with this structure. I guess there's a couple of, I mean, I'll just echo Jack's concern, which is, what are the concerns that we should have? I mean, I know some of them we got. I mean, who's going to communicate with the members? Not us.
Right.
Right?
Yes.
And,
who's going to make the decisions on what the meeting is going to look like?
right. And I think at least going into the thing, we're saying that needs to be the investment people. Who's going to negotiate with the investment people? Well, but what are the hidden pitfalls in this whole thing that we need to? And I guess more important than knowing what those are is are there people going to be there on May 4th who know what those are?
Well, that remains to be seen, but I'd say there's two.
That's not the answer I want.
Two areas at risk. One is a very vaguely written MOU, which you end up not knowing who's kind of responsible for what. That's usually a bad outcome. So the more specific and detailed you can be in that MOU, like who's responsible for client or participant communications, bingo, all client participation. That means there's, none on one side, all on the other, if that's the way you want it.
Yep.
I'm not prejudging. So there's a whole checklist of things, but again, this is not something that hasn't been done before. There's a lot. So that checklist of things is discoverable, and the powers that be between the two boards can figure out what should be in that MOU, and that defines the operation. The other risk is assigning one of those tasks to one of the partners in this that's really ill-suited to do it. So for example, if you were to agree coming out with an MOU that said, no, the Board of Investment is going to be responsible for all communications to clients and all relationships with the record keeper, so those are the two risks I see.
Okay. Really good point, Jim. And I think you used the term in a prior meeting here that this is not a novel thing to do. As a matter of fact, I would suggest that it's probably best practice to move in this direction. Are there going to be some disgruntled members out there who potentially will lose their favorite fund? Undoubtedly. But I believe that with the due diligence that we're talking about doing here, we won't suffer liability risk that is, unacceptable to us. Again, the amount and the quality of the communications to people, relying on work that had been done prior to us embarking on this. I think Bill could speak to lawsuits that have been successful against people who have not done this in the right manner, and recent ones as well. Some of the hidden stickling points that I can see are the transfer of the contracts for stable value with the insurance wraps on those contracts. I think we're going to get very deeply into the weeds on some of those issues. And so can I describe exactly where the pitfalls are today, Mr. Chairman? No, but these are the things that we're going to have to get mapped out.
But if I could, Dory, you are correct. And whether this board knows it or not, there is a hotbed of plaintiff lawsuits against DC plans everywhere, mostly in the private sector, but also some in the public sector. And so one of the things that we preach, and you've seen from Ian, is immense documentation. Like there's a page on every darn thing. And because that is the protection for the board. Because typically courts will look at it and say, no, they thought about this. They made a decision. The decision was within their authority. So, they had analysis to go on. But with respect to the MOU, the relationship between the board, I don't know that anybody and I'm not an attorney, but I don't know that any participant has standing, as they do to complain about investment issues because it's their money, to complain about the whatever relationship these two boards work out. I mean, it seems to me that's not discussable. So they may be unhappy, or some participants may be unhappy about what comes out of the menu simplification. But I don't know that they have unless they assume that it's because the board was involved, this board. I don't know why they would have a beef either with this board or with the MOU or arrangement that you work out. They just may not like what
Yes.
that
the
particular
results,
change.
Yes.
So from my point of view, I think we can handle a lot of those legal problems. But from a high level reputational risk, that's what I think one of the main things this board needs to do. It's our reputation, our reputation. I hate to say this to you, but not quite as concerned about your reputation. And so.
Dory, I am.
We got some people that are, but anyway, how can you address that problem to get me to a comfort level that we're not taking undue reputational risk by doing this from the Board of Investments point of view?
Can I take a stab at that?
Sure.
So at some point, we either have to believe that we're good at what we do or we don't. And I believe, and CEM believes, and RBK believes that we are very good at what we do. We have sufficient due diligence processes in place to vet managers to perform the best of their ability on behalf of our beneficiaries. In this instance, we're going through a manager selection process for others to allocate their dollars to. But we're making sure
To allocate their dollars to.
right, we are making sure that they have the best opportunity set in front of them to make their own decisions at the lowest possible cost that we can deliver. And we're delivering it through a process that does not exist today. The vetting process and the due diligence process that this board has is not available to the members of the DC or 457 plan today. So as long as we're comfortable that what we do for the DB participants, for the state fund, for all of the litigation settlement funds across all of state government that the Constitution says has to come here. As long as we're comfortable with that, I'm not concerned about the reputational risk. I'm actually looking at this as a leveraging opportunity for new participants to benefit from the good work we already do. Is that to say that there aren't risks out there? There absolutely are. Someone is going to be upset that their preferred manager won't negotiate a fee that's in line with the data set we have from FactSet to show what a public market value manager should have. And we say, you got to come down or we got to go over here and get that participant a better deal, and we'll have it all documented. But at the end of the day, the good thing about what we do is it's numeric. It's, manager X is charging you 62 basis points and the Board of Investments is paying them 31 right now. That, as a 457 enrollee, I'm super excited about that.
As a reputational point, you guys also have a constitutional and statutory responsibility to invest all these funds. So, I mean, in many ways, I think you're already covered in that regard. We have a constitutional responsibility to keep the plans on a funded basis.
The other thing I would say is that a vast majority of the litigation that occurs in the DC world is claims that fees are too high and that there haven't been fee reviews that have been documented. Where you have the moral high ground here. If this was a military campaign, you'd be on the top of the mountain because you are, as Dory said, you are the state's authority on investments. So moving these investments here, just, like I said, exactly where else would you move them? And the second thing is that, you know, if you document a detailed review of fees, the vulnerability of any of the decisions that the two boards would share, whatever the MOU says, goes down a lot. Now, is it zero? It's never zero in our society, but goes down a lot.
Why was it set up? I don't want a lot of detail, but why was it set up this way originally? It just did.
I think when, during the 97, 98 interim, when the discussion about the creation of a DC plan was happening, the powers that be at the time thought an advisory council, if this is going to your question, would benefit the board in conjunction with an investment consultant, because the board, with few exceptions, didn't have that investment experience. I think what you will see, though, is if you look at the defined contribution statutes, the Board of Investments is listed as an investment option for purposes of at least the DC plan, if not the 457 plan. So there was thought at the time that the Board of Investments could take over an investment management function over these plans.
But at the time the DC plan was created, there was already the 457 plan, so maybe these.
That's true. The advisory council was actually created at the advent of the DC plan, so that didn't exist for the 457 plan at that time.
So
I can't say what happened because I wasn't around, but one of the potential logics might have been, gee, this board has a lot of interaction with the participant base. 457 DC by its nature, it requires a lot of communication. That could have been the thought. But sometimes it's strange. In the state of Oregon, my home state, the 529 DC plan for college savings is actually run directly out of the treasurer's office. Why? Because he was running for governor and you know, it was his baby. He championed it. You know, maybe that's the way, you know, I have no comment on that other than it's separate for no reason that I can think of.
Mark, did you have something?
Well, just a question. So on these DC plans, and I'm looking at you, is there a different skill set that needs to be employed for these types of plans for investment purposes?
It's not a dramatically different skill set, and I think all the tools are the same. There are, I think, you know, obviously we haven't done this before. So, you know, we've had some discussions with RBK about it. I think probably the documentation effort, as they've talked about, is probably going to be amped up a little bit in terms of, you know, making very sure that we have, you know, that level of documentation that would be required for a DC type plan. But at the end of the day, from an investment side, no, I don't think there's a different skill set. And I think, you know, we're extremely well positioned to take advantage of the scale that we have and the relationships that we have in the business. There will be some differences in the sense that not all, as an example, you know, if we're in a fund by JP Morgan or something, that may or may not be a fund that we can actually invest in at, you know, for those participants. But chances are very high that they have that version, if you will, at JP Morgan, and it just may be, well, you need to be in, you know, this sleeve over here, and you can't be in the institutional sleeve over here. But we still have the, you know, the presence and the scale with the manager to, you know, say, well, okay, you know, sure, we'll be in that fund over here, but we need, you know, this level of fees as well. So
How do you test that?
test.
Well, how do you test that JP Morgan, in your example, hypothetically speaking, that JP Morgan doesn't say, well, you know, you're in an institutional sleeve, and these aren't institutional investors. So you got to talk to these guys over here. And you go talk to those guys over there, and they say, we're going to charge you exactly what we're charging the board now. And you say, well, gee, but the other guys, well, yeah, that's the other side of the house. We don't talk to the other side.
That's fine. And I say, okay, then I'm going to go talk to T Rowe or Acadian.
And
And Mr. Chairman, this is Becky. Just something I'd add in there to John's point is that we'd be partnering right alongside you. And because we see DC plans of all sizes and other institutions accessing some of the same managers, we can look through to those fee proposals and help your staff find if, you know, they're getting the same relative product at the best fee that we've seen offered in the institutional space. Because these DC plans have moved from what used to be a retail type of implementation decades ago to becoming in the institutional world. So we'll help staff and help make sure that those fee investigations and style investigations are appropriate. Because if you think about DC plan investors, all those individual plan participants, the investment decisions that need to be made for them, putting the tools together, which are all the options they can have to access, you have to think about it through the lens of what tools do they need to build a portfolio. And the investment staff has all of those skills. We have all the resource skills to bring alongside that have the databases for the investment products that are available. So it used to be the world where some DC plans were considered as retail oriented in the past, and that's not true anymore.
Okay, well, that answers the nagging question that I've had, which is that it's a sort of the difference between institutional and retail, and you're saying it's not. I mean, well, it's not, or maybe it's not to the extent that it.
The only differences are because of the participant base and the structure of the plan that's defined by federal law. But otherwise, Becky is exactly right. These are institutional plans. They use institutional managers. They use institutional investment consultants. They do use institutional everything.
And Bill, what obligations do you think you have to give investment advice to people participating?
We don't give investment advice to participants participating in the plan. Our board just recently voted to not approve the recommendation of our advisory council to offer through Empower Retirement additional advisory and managed account services. So we're not providing independent advice. Our staff is not licensed to do that, and we don't do that at Empower.
Okay.
That is one of the, I should have mentioned that in terms of risks. If you decide to take on aggressive investment advice giving to participants, whether from this board or this board, that's your choice. You can do it, but it does open you up to other types of claims that you misled.
But no obligation under the statute, and obviously.
No, you do not.
We're not covered by risk, no obligations under any federal law.
So just to go along with John's comments, I don't disagree a bit. I think Becky and I don't disagree a bit about the fact that 95% of everything that these guys do every day would be exactly applicable to DC plan. The three areas, and one for Dan, the three areas that might be a little different is you may choose to do more documentation if only to protect this board and this board, more so than you need to protect it with respect to the DB plan where you do it anyway, but it might be even more important. The second thing is the stable value is a product and that Dory mentioned that is unique to DC plans, not DB plans. Now, is it rocket science? No, but it's different, and it's a complicated combination of insurance and fixed income management. So, but could this staff learn about it, handle it, and become expert in it? Absolutely.
We learned about it.
Yeah, there you go.
And we can learn about it anyway.
Sorry, yeah, that's all right. And the third thing is that in a DC plan, you're really managing collectively thousands of accounts, but all of them have finite horizons, right? So that's different than a perpetual DB plan, but it's not that different. But when you come to something like the QDIA, it's important to that's the option that this board can say, if you don't declare an option, you're going into this. This is it. The default option, exactly. So the consideration of finite horizons is something that matters. But again, is that something that is completely not understandable? Your staff would already knows about it and could handle it well. The thing for Dan, which we've talked about, is to make sure that there's no claim of cross subsidy between the two plans because they have different beneficiaries. But I'm sure that Dan has got 6 ways from Sunday to make sure that doesn't happen. But that goes back to your original question, Jack, about what risks there are. But you see, these things can be figured out and there can be, they can be addressed one by one, either in the MOU or maybe and in the MOU, but also in the Board of Investment's own execution or implementation. So I'll stop there.
So I like to do this just because he's so good about this. So I put Representative Walsh on that. Let's see, do you see pushback from the legislature with the Board of Investments making investment decisions for the defined contribution plan and it's the 457 plan?
No, I don't think.
Okay.
Yeah, I mean, I think it's, like you said, it's probably already in statute anyway, that they have the ability to do that. And so I think it would behoove the Board of Investments to partner up and do it that way. One, I think who we benefiting, the citizens of Montana, and so the employees. And so I think it's, that's, if we can do that, isn't that what we need to do?
Well, that's certainly the theory.
Yeah.
Okay, we got about 5 minutes left. Anything else from anybody?
Mr. Chair, can I offer something?
Yes, please.
My perspective after serving on EAC for a decade or more is that the potential of this would be great for members from what I've seen and what I experienced. And I think the more we can do to help folks keep money in their pocket and grow a more secure retirement, the better off we'll be. And I think the board has capable staff that have proven to be experts. Through my years on EAC, we went through various advisors, and those advisors change from time to time. I think that I've seen the best expertise I've seen anywhere on this staff. So I think in looking from the members' perspective, and that's part of what I think my job is on this board, I look forward to hearing more about this. I think our members could get more benefit from their invested dollars through the work of this board. So I'm not saying what the outcome should be, but I certainly look forward to the discussion. And I'm eager to hear more. Thank you.
Thank you, Diane. Yeah, Jeff.
Just to clarify, I think we might have touched on this last time, but would there be an option for the DC 457 participants to invest to kind of a parallel vehicle to the pension, investment allocation? Is that the intent at any point?
Possibly.
Yeah, there's potential there in some areas, I guess, but that's kind of probably a down the road.
I got you. Okay. That's
Discussion, I say, when we started to figure out, what's the appropriate investment offerings that we should put out there. I think that could be something we could discuss, but it's probably not the most immediate, benefit, I guess, or need that I would.
We would have to offer, right?
Right.
I mean, we would have to offer the Board of Investment Fund.
There'd have to be a lockup period,
Right.
there'd be a lot
of issues there.
Is it a private equity? or
Right.
is it
Is it
real
private
estate?
equity
Oh,
and-
real assets, real
And some
estate.
plans do that sort of thing, so
There's
it's
a
not,
whole
that's
lot more
not,
risk
that's not
there.
wholly unknown, but
Yeah, let's not do that this year.
no.
I will say that
Probably my closest one to buy a rail car.
So go buy a rail car. Bill, that's your advice? We don't give investment advice, but so go buy a damn rail car. You want a rail car?
never give investment. I call John.
Just another follow-up on that. So to kind of maybe appease current plan participants, this may be unique to our own 401k plan or maybe not available. But at Glacier, we're able to actually direct a portion of our retirement into, they call it a brokerage link, where we can basically invest in any, market options. That like an open way. Is that something that you guys would consider for, for this transition, just to kind of appease some of those participants who have their favorite selections, and then they could potentially still invest in those?
That's not something, Jeff, that we have discussed, so I would rely on RBK's advice probably about that. I would have to say that my impression, and correct me if I'm wrong, Maggie and Bill, is that our board was very excited about making this move and finally getting the ball rolling here, because I think, as Diane pointed out, we have to believe that this is going to end up being the best result for our participants. And so my takeaway from our board meeting of Thursday of last week is that I think our board is excited and are going to be on board if we come back with a very well thought out plan.
So Jeff, I don't understand. You can take a portion of your
So we
of
have
your
our,
retirement that's matched by where there's some match by your employer.
so we have our array of investment options.
Right, you
Kinda
got
like
10
what we talked
investment
about.
options and 11 is,
Also, the open window is the term that, so we can direct a portion into a separate account that you could then invest, just like your own personal brokerage account.
So you can, by doing
and how
that,
does
you
the
choose to
employer
pay the
keep track
fees.
of it?
Correct, and then you pay the
He
fees.
pays the
direct,
fees directly to that broker.
you
so-
pay the
So that we
fees?
have no control
Yeah.
over those fees.
So you would have.
And you don't, and your employer doesn't need to keep track of that.
I hear that, that's not, I mean, we're.
Somebody's got to keep track.
There's a risk, I got ERISA things going off in
Well,
my head, I've got
as-
statutory
I mean,
things.
deferred comp technically is an asset of the state, correct? I mean, isn't there that unusual deal about it? It's not.
It's the same for a bank too.
So this open broker window is, it's quite common. Probably more than half of DC plans have it, but it is controversial for the reasons that Dan hinted at. A lot of boards, DC boards, fiduciaries are uncomfortable with folks in participants going outside the menu that they have set up as options. And so there are several different kinds of windows. One window is you can buy any stock, any bond, Bitcoin, whatever it is that you want. But there are also restricted windows, which is you can only buy mutual funds, but you can buy them from whoever you want in any mutual fund. And oftentimes there's a cap on what you can, how much of your account you can actually direct. It turns out that they have very small usage by and large. Not very many do. And so it's a major fiduciary decision. You've made the decision that you don't want to go there.
Yes.
Now, with respect to the other question you asked about essentially exposing individual DC members to DB investments, I only know of one fund that does that, and that's CalPERS. I have consulted with another major fund in Texas that wanted to do it, but their attorneys were very unhappy about the potential for either claims of or actual cross subsidization. That is, you were doing things in the DB plan that were really for DB participants and didn't reflect the interests of the DC participants. So that is one of the reasons we see what you suggested in your first question very, very rarely. And I'm not saying it's a bad thing, good thing. I'm just saying there are concerns about it, and that has led most states and cities not to do it.
Okay. Once again, you've used your time wisely. I know, I'm serious. Every time you show up, we have a great discussion. So
Thank you, Mr. Chairman. We always appreciate the invite to come and have discussions with you guys
Yeah,
and gals.
and we'll look forward to hearing what happens on May 5th, May 4th.
Are we gonna lock up over here?
You have natural light in your conference room. I kind of like.
Okay,
that.
you guys work that out.
All right, we'll
Let's
work
go
on
on
that.
to,
You'll be in town, Carl. You'll probably want to go. to that.
let's go on to tab 4
Thank you all.
Thank you.
and the market assumptions. If you're ready, Jim.
I am.
So you
I am
have
more
to,
than ready.
yeah, sure.
Okay. We
So-
got
Thank
it,
you.
You guys.
Thanks.
So
we
I
got it
think we have
listed
a,
for 45 minutes. So.
I hope I don't need that long, but it's up to you. So you have a presentation in front of you. It's called, what is it called?
It's beyond tab 4 and it's called
Yeah, it's called
RBK
RBK
Capital Market
2022
Assumptions.
Capital Market Assumptions. It's a summary. There you go.
One summary and one.
So I'm on page 1 and there's some important points to make here. First of all is why do we go through this effort every year, which is a massive effort? And why do so many other, at least the major investment consulting firms and some asset managers go through it? It's because, as we've often said, asset allocation accounts for somewhere between 85 and 100% of a fund's returns and risk over the long run. It's way more important than any manager that you would select or anything, way more important. And designing a strategic asset allocation for a perpetual fund like this requires at least some thought about forward-looking expectations for what asset classes might behave. A lot of uncertainty, a lot of disagreement about this topic, about where people come out, but the absence of it leaves you with no map at all for the future. So as uncertain as it can be, it is a best practice for investment consultants to do and for asset owners to think about. And I know John and his staff think about it internally on their own as well. So we do more than 50 of these, that is 50 asset and sub-asset classes. And that doesn't include the custom assumptions that we do when somebody has an asset class that is uniquely constructed. Big effort at our firm, robust discussion, lots of research. In fact, here's the like almost 100-page white paper. If you ever want to like get down and dirty on capital market assumptions, you're welcome to read it. We'll give you as many copies as you like. We have a lot of trees in Oregon, so we got them. The forecast horizon differs a lot. When an asset manager tries to do this, they're doing it for a product that they are offering to people. And the product typically has to perform in the short run or they're going to lose their assets. So they care a lot about the assumptions that they have for, say, the next 2 to 5 years. The problem with that is that that's the most uncertain period of all. The longer the forecast, the more likely it is going to be close to accurate. Short-term forecasts, by definition, have the biggest amount of uncertainty. For strategic funds, we typically use 10 plus years, which it varies from 10 to as far as 20 years, but it's long-term. And we'll talk a little bit about that later, but some people might say, well, if it's that long-term, isn't it going to be stale? And that's why we refresh it every single year. And we'll talk a little bit about that refreshment in a moment. What we look at are 3 things about an asset class. We look at what the return might be over this forecast period. And there's 2 kinds of returns to look at. And I'm going to show you a neat example of the difference between them in a moment. But one is what we would call arithmetic. It's the average return. But we know that, if you had 2 pots of boiling water and they averaged out to be about 72 degrees, or one was boiling and one was freezing, that's not the same. An average is not as helpful. An average, the arithmetic assumption is essentially what you would expect any given year in the forecast period to happen. But what you would expect over the entire forecast period is what we would call the geometric or the compound rate of return, sometimes short for GEO. And that is what the annualized return would be over this set period of time. So it's not the same as the arithmetic, and I'll show you why. Essentially, it's always lower so long as there's any kind of variability in the returns. And the reason for that is simple. If you have something that averages a 10% return every year, then its geometric return and its average return be precisely the same. But if you have one year when it's 5%, another year when it's 15, another year when it's 5, another year when it's 15, you'll still get the same 10% average, but the geometric or compound return will be lower. And the reason for that is that if something declines by 50%, it has to gain 100% just to get back to its starting point. So you've heard me say in past board meetings that volatility in a return is the enemy of long-term compound returns, which is why we care about volatility as a risk measure. Then we look at, so we do look at volatility. You can see that that's the second thing, risk. And then we look at correlation, because correlation is the thing that can make asset classes that behave differently essentially merge together and complement one another and smooth out volatility. And when volatility gets smooth, it's the degree to which it's an enemy to compound returns gets diminished. So that's why we like that complementarity. The other thing is that we don't assume that there's any manager underperformance or outperformance. We use what are called beta measures. So that would be using the S&P 500 or the Russell 1000 in equity, as opposed to a guess that your manager would outperform by 20 basis points a year or some such thing. Because these need to be the building blocks. This is the skeleton. What you do after that is all about manager selection and asset class composition. The last thing I would say on this page is that we do annual updates to exactly prevent it from becoming stale. Even though it has a longer time horizon, we review it and change it every single year. And you'll see some changes when I show it to you in a minute. Usually those changes are relatively small because not a lot changes in the capital markets over a year. But sometimes things do, and they do a lot, and particularly valuations. So there have been at least 2 episodes where we've made huge changes in our capital market assumptions. One was at the bottom of the great financial crisis when everything was for sale, where we raised our forward-looking capital market assumptions. We don't know the path of recovery, but the odds were so much in favor of recovery that we raised our assumptions going forward. The last time that we did it was during COVID, where we actually ditched our current assumptions and made a brand new set on the spot because there was a 30+ decline in the equity markets. And it made sense because the valuation change was big enough that it affected the whole prospect of what returns might be over 10+ years. And it's usually not historical performance, and it's usually not economic environment. It's usually changes in valuation that make for big changes in capital market assumptions. So page 2, this is a really important point, and it's so hard. It's my favorite. It's one of the first pages that I wrote when I came to RBK 17 years ago. But it's so important when thinking about this, because we are often asked, well, how good was your equity assumption? How close over a period of time did it turn out to be? And it turns out that doesn't matter. What matters is that what we call relative accuracy, because asset allocation is a competition for your fund's assets between asset classes. It's a competition. So relative accuracy is way more important. So for example, if you got the spread in performance between equity and fixed income just right, even if you got the absolute magnitudes completely wrong, you'd have a good asset allocation. It's the difference, because the difference is what the computer looks at when it essentially allocates assets out in this competition. It's not the absolute number, it's relative to the other options that you're considering. So does absolute accuracy matter at all? Yes, it does. Because, for example, if you were thinking about raising benefits a lot, for example, you might say, well, I really want a good asset allocation, which relative accuracy is designed to give me. But now all of a sudden, if I'm going to actually put hard dollar liabilities on our plate, then the absolute expectations for returns start to matter a lot. So absolute accuracy matters, but it's not as important as relative accuracy, which essentially sets the foundation for the competition for your assets among the asset classes that you've chosen to use. Questions? Page 3. Looking at page 3, what we're trying to do here is a little bit of a perspective about where today's assumptions are. So the top panel, as you see here, is RBK's long-term expected returns as they stand today versus a historical range of 20-year annualized returns. So we look back long ago, back to 1926 actually, and looked at various, the range of outcomes for these rolling 20-year periods, and that's what the bars are. Sometimes they've tended always to be positive because there's a positive skew, positive lean to returns. If you look, for example, at large and mid-cap US stocks, but they vary tremendously. There have been 20-year periods where returns have been, as you can see, 2.5%. But there are other annualized returns, that is, and then there have been other periods where they've been over, 15%. So where do we stand today? This is designed to sort of give you a sense of where we are versus market history. And as you can see, in most cases, we're toward the bottom, say quartile or third of returns that have been experienced over similar horizons. If you look at the bottom panel, instead of looking at actual historical returns, this is a plot of, we now have enough history for doing these capital market assumptions in a disciplined way that we can start comparing where we are today versus where we have been in past years. And as you can see, we're way to the left at the moment. We're obviously particularly cautious relative to our own history of projecting returns. And so that's just, the rest of the pages will give you a sense of why that's the case.
What's historical range for that bottom?
The historical length goes back, if you look at the footnote, to 2006.
Okay, thank you.
Which happened to be the year I joined the firm. So, so on page 4, what we're trying to do here is to examine what I was talking about before, how uncertainty affects, and particularly volatility, affects return expectations. So this is the standard deviation of returns for these various asset classes and where our estimate is currently. And as you can see, our estimate kind of is right in the middle because we have no reason to think that returns from a standard deviation point of view, from a volatility point of view, are going to be either calmer or more erratic at the moment. But one of the things that I would point out is, let's look at emerging markets. If you look at the left-hand side, you'll see emerging markets. Look how wide that bar is. What that is telling you is that emerging markets can have spectacular years and really poor years and lots of volatility. Now let's look down, for example, at US aggregate bonds. Look how narrow that is. Bonds don't move around quite as much as equity in general, and certainly not emerging market equity. Now, if you have the paper copy in front of you, I want you to draw, put your finger on emerging markets and then drop down to page 5 and look at emerging markets. These are the compound returns. And remember, I said that emerging markets had enormous amounts of historical volatility and a higher volatility estimate because of that we have, as you can see in the black dot. So let's look at the compound return for emerging markets. Oh my goodness, it's 7.5%. But our return that is considerably lower than our arithmetic return. Why is that the case? And let's see, there is a cool place where we can find that. So if you look at at our estimate for US Ag bonds on page 3, you'll see that we're just above, close to 2%, 3% in that range. And so with all that less volatility, the US Ag compound return is very, very close to its arithmetic return. That is, there's not much volatility, so that enemy of compound returns is weak. But in the case of emerging markets, those compound returns get a haircut because of the higher volatility. So, page 6. What were the big topics that sort of came to the forefront in this year's capital market assumptions discussion? Now, remember, these are all based off end of 2021 numbers because we want to get a full set of apples to apples end of year numbers so that they're all the asset classes which compete with one another for your capital get looked at on the same basis at the same time. And the three big challenges that we talked about were, and this will come as no surprise, inflation. We were already seeing signs in the fourth quarter that inflation was starting to break out. We were being told by the Fed that it was very transient, not a problem, would go away soon. We weren't so sure, so we raised our inflation assumption by a full 0.5% to 2.5%. That was a reflection of what we thought might be coming out for the next 20 years. Of course, right now, it's running well above that. But if it runs this high for 20 years, John, what do you think that means for the markets?
We got bigger problems.
We have bigger problems. So essentially, it still reflects a reduction in inflation in the latter 3/4 of that 20-year period, despite the fact that it's well above that number now. And we can talk about why that's the case, but you can see that there's a few mentioned here: big deficits, heavy debt. In my lifetime, in nobody's lifetime, has anybody seen the US take on so much absolute debt or debt relative to the size of our economy as we have in the last 5 years. It's been astonishing. But there's also demographics. The developed world is getting older. Some countries faster than others. But those are the reasons why we think that while it might not be nearly as transient as the Fed originally thought, there are reasons to think it will decline some at a reasonable period sometime early on in this 20-year period. The second big theme was mean reversion. Now, mean reversion becomes a big topic for discussion when an asset class has a huge either decline or a huge jump. Well, we had a huge jump in equity, especially US equity, big jump. And so mean reversion is a fancy way of saying, unless we think something is totally different about the entire world, this rate of return has to come back closer to normal. And the question is, how fast, when, and to what degree? So I'll show you in a minute sort of how that figures into to our work. But mean reversion is one of the most powerful and most dependable factors that we see in the capital markets. And we see it in the real physical world as well. And so it's something that you have to take account of. And I'll show you some evidence as to why it's so powerful, but it doesn't tell you anything about when it's going to occur or how fast. And that's the dilemma that short-term investors face. And that's why short-term periods have such high volatility. And the last one is yields for fixed income had already started to rise in the fourth quarter. When fixed income rises, the coupon pays you more. Now, if you happen to be an owner of equity or fixed income at the time, you take a capital loss. But from that point forward, the return expectations go up. So we'll talk a little bit about that in a minute. So page 7, I don't want to go into this too deeply, except to ask a question. Yeah,
just on inflation. So specifically to the deflationary factors, how are deficits and debt deflationary factors?
There's a couple of things. One is that just the historical data that we have for countries that have gotten heavily indebted or economies that have, it has suppressed real growth very significantly. There's lots of work on that. But the mechanism by which that occurs is essentially you take on debt, you have to service it, you have to pay interest. And that siphons money away from consumption, investment in the real economy. So essentially, when you take on debt, you better have a positive real return for it. Otherwise, you're essentially just pulling money from the future now and then paying for it all along. And the paying for it all along subtracts from economic activity.
I got you. So on a 20-year window, it creates a deflationary kind of pressure.
Yes.
Short-term window, because I guess a lot of what we're seeing right now, short-term is kind of.
Short term, it's like throwing gasoline on a fire. Yeah, I mean, Greece was a perfect example. I mean, they borrowed the heck because they got access to the euro. They threw money all over their economy. They were just going great guns until they couldn't borrow anymore. And then their car literally hit a brick wall. Because they had all this debt to service, couldn't borrow anymore, couldn't roll the debt. So all of the debt service and debt repayment had to come out of consumption, investment, and so on.
John, how many Greek bonds do we have?
We have a spreadsheet that'll tell you now. Thank you, Matt.
So Jim, similar question, I guess. Demographics and globalization have clearly been deflationary factors over the last, couple decades anyways. Seems like maybe that tide is turning on both of those metrics. I'm just curious of any, more in the weeds thoughts you have there.
I think on globalization, John, yes. In fact, there have been a few pundits that have said globalization is over, blah, blah, blah. And, but what's interesting though, is that globalization essentially lowers the cost of production and satisfying goods and demand for goods and services because you reach out, it's comparative advantage in economics. So it's possible that a movement back to in-country work investment might actually be deflationary to some small degree as well. But our access to cheap labor in China, Vietnam, and so on, may be no longer a driver going forward for obvious reasons. In fact, China has actually lost market share to Vietnam because China's wages are higher than they are in Vietnam. So that's a real possibility. Although demographics, I'm not so sure that has changed. Birth rates are not going up anywhere. But for the US, demographics are two parts. One is what your birth rate is, especially net organic growth, deaths, births. But the other is immigration. The US's demographics have been better than most of the developed nations because we've had a relatively high degree of immigration, whereas Japan has not, Italy has not, Russia has definitely not. Those are three very aging populations, and they're all suffering pretty substantially from demographic effects on economic growth. So does that make sense? So so page 7, I won't spend a lot of time on. The only thing that I want to focus on there is that we use a building blocks methodology for each of these asset classes. The building blocks are not always the same, but we try to get really granular on these things. And so let's look at public equity. It's in the upper panel in the center, public equity on the left. We look at income, which is dividends, okay? That's part of return. We assume that there will be, that they will be able to increase at least with inflation. So inflation becomes a building block. That means there's no expectation that there'll be real value declines in their ability to produce earnings. And then we look at expected earnings growth. There's a very slight effect on these on currency, something new that we've added to our methodology. But look on the right-hand side, valuation, it says plus or minus. That essentially is the regression to the mean building block. And it can either raise our expectations or lower it. It's lowering them right now, and we'll show you that in a minute. But this is where the biggest guesswork occurs But it also is the place that can have the biggest effect on forward-looking returns. If we drop down, this will be one of your favorites, to private equity. Notice that our assumption is based on a large and mid-cap equity assumption because remember I said relative accuracy, this is a competition between asset classes. We can't have private equity's assumption be 500, 800 basis points higher than public equity, and because it would draw all the capital out of the public markets as much as possible. So we know that there has to be a link between the two. The spread is what we're looking at. And then there's a return premium. And the illiquidity premium is essentially a payment that, and we've talked about this when we talked about benchmarking, and I don't want to get into that, I know. But we talked about the fact that investors should get paid something for tying up their capital for as long as 10 or 12 years. And so that's the illiquidity premium. It's been evident in historical data. It's evident in your own performance numbers. And so it's real. The question is two things. One is it getting bigger or smaller, which is very difficult to determine. And two, it can vary with investors. So for example, if your plan was very young demographically, and you were paying out very few benefits, but you had lots of new employees rolling in with lots of new contributions, you could take on a lot of illiquidity. The premium that you would ask would be very small. If you flip over the other side and have a closed DB plan or something like that, where their finite horizon, their demographics are getting really old fast, what they would need to demand for taking on illiquidity would be much higher. So this number is very idiosyncratic or very specific to institutions, but we try to estimate it for the average fund. So if we pop to page 8, what I want to show you here is that building block that talks about regression toward more normal valuation. And you see the building blocks that make up these assumptions that are aligned with the building blocks I just showed you for public equities. And notice the on the two left-hand ones, but also the two on the right, the big black blocks that are below zero. That is, they subtract away from the expected assumption. This is because we expect returns can't continue to be for certainly 10 to 20 years at the same pace that they've been in recent years. And so what that means is that there's a valuation adjustment that will take place sometime, we think, over the course of this time, if nothing else changes, that will tend to bring price earnings metrics down somewhat. So while earnings growth and dividend growth are pushing up the value of public equities, there's going to be some of that value that's going to drain away because the price that the market is willing to put on those equities doesn't increase in concert with it. Again, it doesn't say anything about the path, and it doesn't say anything about whether or not it will happen suddenly or not. In the case of COVID, the COVID decline hit a very highly valued equity market and took 30% plus off it in the space of, John, 8 weeks. I mean, it was very, very sharp. GFC, it took more like 6 months. But the readjustment of values was much faster than we would have anticipated, actually. This adjustment, we could have what's called a soft landing, and you could have this occur, this leakage of value leak away over the course of more than 10 years. And it would simply be annoying as opposed to catastrophic like the GFC was. If we go to page 9, one of the reasons that we believe that there'll be a regression to the mean is the association between current valuation and subsequent, that is the next 10 years. This plot essentially takes every dot for the past number of years set from 1926 on and says, okay, here was the valuation of public equities, US equities at this time, and then what happened in the next 10 years. And as you can see on the left-hand side, we have the actual returns. On the horizontal axis, we have the evaluation measure, one of the most commonly ones used, called the Shiller PE. And so it basically says whether stocks are cheap or expensive in the case relative to historical standards. And so as you look here, you can see that the Shiller PE at the time we struck this, which was on December 31st, if you look at that down at the bottom of that line that goes, you'll see a red dot. And it basically says that this was one of the most expensive equity markets in the history of the equity markets. And when we see expensive markets, we tend to see returns for the next 10 years for equity that are very low. So that's why the line has a negative slope. If we move over to the left where it's much higher and it's showing 10 and 15% kind of returns, that is coming from a starting point of PEs that are 8, 10, 12, 15, but we're not even remotely close to that. So again, we don't know when this will normalize, and we don't even expect it to go all the way back to mean, because there's reasons that we think that equities will continue to hold a fairly high valuation, low interest rates, and if our expectation about inflation is correct over the long run, equities should still be more expensive, but they're particularly expensive than they were at the beginning of the year. So far, the Russell 1000, a big broad number, is down 6.5%. That's not material enough to change this. If it had dropped 25 or 30, then we'd be talking about moving to the left on the x-axis. And that means, because the line slopes upward to the left, that means that the return expectation should go higher, which is exactly what we observed during the COVID decline and why we raised our expectations for returns going forward. I'm going to skip over the international equity one to talk about the fixed income one on page 11. Notice that in page 11, that relationship between valuation, in this case, valuation is expressed in the yield on fixed income for the Barclays Agg, and what happens to returns for the Barclays Agg over the next 10 years after we've observed that valuation. Notice that this line slopes upward to the right. What it's basically saying is, if you buy fixed income that has high current coupons, you are very likely to have good returns for the life of the Barclays Agg, essentially. And notice that this doesn't have that cloud where there's lots of noise and uncertainty. This is a really tight relationship. And so this has caused one market pundit to say, if you want to know what fixed income is going to do for the next 10 years, look at the current yield. So long as the duration is long enough, at least 10 years, and certainly longer, you basically have figured out what your return is going to be. And he said, and that means that current yield is destiny for medium to long-term duration.
Question.
Yep.
Both on page, let's see, page 9 and page 11. So the bottom, the bright blue, is that 2010 to 2011, or is that 2021?
It's 2021.
And that's true on the other one
Yeah,
behind it.
it's 2021. Yeah, I noticed that myself.
Didn't bring it up though.
I tell you, Erin's going to get, when she gets better, she's in trouble. Although, if that's the only mistake that she made in this,
Just couldn't figure out how come she's been blue dots for just 2 years. That was what I was having trouble with.
yeah.
It was a good 2 years.
So, yeah, exactly.
Very exciting.
So the last thing I'll point out, and I won't dwell on this, is that on page 12, there are fixed income asset classes that are called spread products. John and his team have mentioned this many times, and that is they're bonds, but they trade above treasuries typically, almost all the time. And so in order to estimate a forward-looking return for these types of fixed income, we have to look at their option-adjusted spreads, looking at them versus history, and try to figure out whether those spreads, which should also regress toward a normal number over a long period of time, although they're powerfully affected by recession or by big spurts of economic growth, because they essentially are expressing credit risk. And so in big spurts of economic growth, you tend to get really low spreads because nobody thinks anybody's going to go bankrupt. But when there's a recession looming, spreads can, as the phrase goes, blow out, and they get very high. Real estate, very, very similar to a blend of equity and fixed income. Building blocks that we use are income and valuation, but the valuation metric here is the cap rate instead of the PE, but the process is quite similar. I won't go through hedge funds. I talked about private equity already, so maybe the last thing I'll do is jump to page 17, which is the last page. And you can see that our expectations in nominal, that's another word for arithmetic, I'm talking about the right-hand panel, for fixed income actually went up a bit this year, and it's because yields are higher. Now, the fact of the matter is the pain comes first when this happens. So the capital value of fixed income went down, but the fact that it went down means that its future expectations are higher. But you also see that with respect to equity, particularly given the huge run that we had in 2021, we trimmed our equity related numbers. And that included even equity REITs like that you see down on the down on global REITs down below and about 2/3 of the way down. And again, this is a way of essentially being strategically contrarian, but not trying to bet the farm. These changes are modest and granular, but they all reflect a tendency to expect that there will be, over this strategic period of time, a regression toward the mean and a reflection of current yields, current dividends, and all the things that in current valuation that we see in the marketplace. So this is all summarized on page 18 by what's called the capital markets line. There's a thesis that's well accepted in financial economics, which is you want higher returns, you have to take greater risk to get them. Notice out on the far right-hand side, the highest expected return is on the vertical axis, comes at emerging market equity. We talked about how volatile that is. Long ago, we had a client, somebody that sold their company for many billions of dollars, and he put a huge amount of his money in emerging market equity. It was a family office. And it was because he didn't need it. And he wanted to build the biggest nest egg possible. And because he didn't need it, he didn't care about the volatility. And so, that was his choice. But as you can see, if you go far left, what's the lowest risk? Well, it's cash. Guess what's the lowest return? Cash. And everything else is in between. And so the capital markets line essentially is a picture of the competition for these asset classes for space in your asset allocation. So with that, I'll stop, and I think I've probably bored you enough, but I wanted to make sure I gave John plenty of time to talk about how he thinks about capital market assumptions, as well as a dozen other factors in thinking about how he sets up and recommends asset allocation and executes it on your behalf. Any questions?
So on our main job is asset allocation. And we went all through this, but on a high level, what's that mean about where we're at today with our asset allocation?
Your current asset allocation, you're very well diversified. Notice that we are relatively optimistic about real estate. You have embedded in your asset allocation now real estate. It has proved to be both a volatility reducer as well as a return generator. You have diversified your fixed income away from the part of fixed income that has the worst outlook, which is treasuries and core fixed income. So what we would say is that you are making the adjustments necessary that reflect much of what you see in our capital market assumptions And it's because your staff and ourselves, and, you know, we talk frequently. It's not because they're following this, it's because their own instincts, I think is fair to say, tend to lead them toward the same kinds of actions, whether it's, you know, continuing to invest in private equity, where we see the differential. We talked about the spread between public equity and private equity still being positive and supportive of your allocation of capital. And so we don't have any complaints about how you're handling asset allocation.
That sounds like good lead into you.
You know,
I'm sorry. I didn't mean to
call it good.
I didn't mean to cut anybody off. Anybody have any questions for?
Yeah, I have one. Well, I guess I'm a little surprised that I didn't hear any pushback from any of my more seasoned compatriots here about your inflation estimate. You know, I guess I'm hearing a lot about how I didn't live through the 70s and didn't, you know, I didn't see inflation at these numbers.
I did.
Yeah, no, I figured. So.
Many of us did.
Yeah,
We don't remember the.
that's the 60s, right?
I drank.
Oh, yeah, such a good time.
Well,
But-
and it's for some of us, it's spilled over. And it's,
But I guess from that perspective, what's your rebuttal to that mindset? You know, obviously 2.5% is far off from what we're experiencing right now and likely experience through the rest of this year. I know you have a 20-year
Yeah,
window.
no, yeah, and you know, I think that's a really good question. I'll say several things about it. One is 2.5% is noticeably higher, at least a full percent higher than the average that we've seen over the past 12 years. So, you know, depends, what are you comparing? Compared to what?
Yeah.
Compared to the last 12 years, this is a high number. Compared to what we're experiencing now, it's a low number. So we've done lots of modeling over a 10 to 20-year period and asked the question, how fast does this inflationary period have to disappear in order to get, you know, 2.5% over 20 years? And what's interesting about that answer is that it has to disappear within 3 years. Because for every year that, say, inflation is 5% or higher in that period of time, that means the 2.5% is too low. So does that kind of give you a picture?
So it's, the current trend has to disappear in 3 years.
Yeah, it has to roll down toward that 2.5%.
Do you, obviously you feel that that's a possibility here.
Well, the Fed says it's going to make it, it's going to do. Remember, this is current inflation. The Fed's target is 2%, and they're willing to go a little bit above it for a period of time. Now, they remind me of the old cliche, the dog that chased cars. When he finally caught one, what the heck was he going to do with it? Well, the Fed has been chasing, as has, you know, the Eurobank and the Bank of Tokyo have been chasing inflation for decades now. They finally caught it. Well, they don't like what they caught. So that's one reason we would have to go toe to toe with the Fed and say, you are wrong. You don't have the tools to do it. And there's a possibility they don't. The other thing, though, is that there's a possibility that if they at least try, they could trigger a recession. Recession has a powerful effect on inflation. Usually, the 70s were an exception to that, and that's why you see the term stagflation discussed. I know you were around at the time, but it was the worst investment environment that I think anybody has experienced since the Great Depression. Stagflation is the worst thing because you have all the bad stuff. You have high interest rates, you have high inflation, and you've got a recession at the same time, or at least very low growth. I mean, that's like the trifecta of evil things. So no one wants to go back there, but if we did, I think there's a very high probability that inflation will collapse at some point, as it did when Volcker raised interest rates to over 12%. Boy, that was painful.
John, you're up.
Okay. So tab 5, So what do we do with the capital market assumptions? And Jim touched on some of this, of course, but so ultimately we use capital market assumptions to help us determine the optimal asset allocation best we can for the Board of Investments. It's an annual process, as Jim talked about capital market assumptions being an annual process, as you know. Going through the asset allocation is also annual, and it gives us an opportunity to look at our goals and whether we think we can achieve those goals over the long term, given what we expect to happen, murky as it can be. Also gives us a chance to look at the constraints of all of our plans, whether it's the pension plans where we're looking at return expectations that are effectively given to us from MPER and TRS, but not in the case of, say, trust fund or state fund, thinking about that and whether or not our asset allocation is reasonable in terms of achieving those types of goals. What's the risk tolerance, which clearly doesn't often change, but we're thinking about, what's our time horizon? Has that changed for any reason? Any legal or regulatory constraints that may exist or have changed over that time period? And certainly what are our liquidity and our cash flow requirements to support whatever either pension plan or other goals that may be embedded in any of the portfolios that we're managing. So obviously it's a very complex question, and Jim framed it well with the capital market assumptions. There's a wide range of potential outcomes here. And at the end of the day, we're trying to predict the future, and we're going to be wrong. I mean, we're flat out going to be wrong every single time. So why do we even do it? We do it, I think, because it helps us determine, what's a reasonable probability of meeting those goals. And I think you have to think about it really in terms of probabilities at the end of the day. None of that's going to be precise, but to Jim's point, in terms of kind of mean reversion, I think we probably will all agree it's unlikely that we're going to get 20% equity returns year after year after year. And hopefully it's unlikely that we're going to get negative 20% equity returns year after year. So we're trying to narrow that range of possible outcomes that we think are reasonable and put some guardrails in place that will help us avoid the most extreme outcomes. I think that's really kind of the key at the end of the day, and particularly, of course, the downside extreme outcomes, because that's a killer for any of our portfolios and plans. So looking at page 3, kind of just a review of our basic process here. As Jim noted, asset allocation is one of the most important decisions that this board makes. We look at it annually. We start typically, Jim's starting far earlier with his capital market assumptions, but in say August or so, we're thinking about it as a staff and reaching out to our RBK for discussions and other help. We're gathering our own market information. All of the senior staff, the directors primarily, are looking at the economic resources that they have, talking to their managers, their brokers, et cetera. They've got a view on what they think is going to happen. Independently, all of us put together what we think the asset allocation should be. We never agree. It's always very different. And I would say it's always slanted towards, what asset class are you in? Are you in the private investment side? You probably have a very different view than the fixed income guys do. And that's all a good and healthy debate, I think. At the end of the day, we kind of bring all that together, typically give RBK, some range of the scenarios that we sort of came up with as staff. They put together, some additional scenarios typically that they probably have or have seen, and they run all of that through their mean variance optimization model. We won't get too into the weeds there, but once we do all of that, we go to Portland or maybe get on Zoom if it's a pandemic, I guess, discuss all of that, and ultimately I bring to you, what the recommendation is from staff as to the asset allocation ranges going forward, which obviously guides how we manage the portfolio, at least for the next year, and go from there. So page 4, so capital market assumptions. So they're a key input, I think, as you all know, into that mean variance optimization model, because that model is providing the optimal, optimal weight, if you will, of the asset classes based on the risk and return inputs that are put into that model. And so RBK has, a very well-researched, consistent, logical process. I have absolutely, no issues with it. Read all of their stuff and the white paper that gets put out and things every year. But at the end of the day, I think as staff, we also have a responsibility to go out and look and say, well, what does the broader market think? Because, I think as Jim said, and I'm saying is, nobody's right at the end of the day. And so I think this is an area where, in my view anyways, looking at as many experts as you can get and kind of combining all of that information is going to be good and valuable information to at least take into consideration. Doesn't mean we have to listen to it or do it, but I think we'd be foolish not to take advantage of all the resources that we have in-house here. So typically the last several years anyways, we've looked at the Horizon survey, which is just a survey of capital market assumptions that are put out from a number of asset managers, broker dealers, other consultants, who, of course, I don't know the names of any of those other consultants, but they're in there somewhere.
Let's keep it there. Right.
So, nothing magical per se, but 2021, there were 39 entities that were in that survey, including RBK. Names that you would recognize, JPM, Vanguard, et cetera. And so I guess, saying that I think they're all reasonably respectable entities that are putting information out there. Certainly, and we get the details of a lot of those, right? So, during the summer and the fall, we're getting capital market assumption research from all kinds of entities that are sending us stuff and looking at those individually as well to some degree or another, maybe not in huge detail, but kind of seeing what the waterfront is out there. And there's significant differences in those return and risk assumptions, although they do, I think, tend to cluster, I guess. And to that point, I guess, looking at page 5, which I think is kind of one of the most interesting pieces, and this is just right out of the last survey from Horizon, you can see the range of expected returns from these various entities. And so, the way I guess I think about it is there are a number of different people looking at essentially the same set of facts and coming to different conclusions. Now they're putting them together differently and all those things.
And they've got the same bias our staff does, that lo and behold.
They do, of course they do.
Equity managers
Yeah,
think equity is
sure.
going to be better than anything else.
Absolutely, yeah. They've all got a bias there somehow.
John, do you have a specific date for that Horizon survey?
So the Horizon survey
Or I
comes
should say,
out,
when did they prepare their assumptions?
this particular one, it came out in August, but it's 2020. It's basically, I don't know that they're all exactly doing it as of 12/31 as Jim is. So, but I would say relatively close to that. But there could be some that are, maybe it's a June 30th for some. And to your point, I mean, that could be a big difference in some years, right?
Yeah.
That some people are doing it. If you did that in 2020, if you did your capital market assumptions as of 12/31, and then you had somebody else doing them as June,
Yeah, okay.
very different. So yes, that is a factor for sure. But at the end of the day, I think staff thinks, more data, looking at it from different angles improves our ultimate decision-making. I would completely agree with Jim that the most important thing is the relative ranking here, because how you put that into the model matters, right? If you expect private equity to be the highest returning asset class, and you think that it's going to return 9% and somebody else thinks it's going to return 12, but your ranking is the same, you will basically come up with a very similar asset allocation, right? You would only run into big differences if you were somebody who said, well, I think private equity is going to do terribly. It doesn't have any, positive return to public equity, and therefore I'm going to, underweight it. Well, then public equity is going to be a much bigger piece of your asset class. And I would say that when we have these discussions with RBK, I think 99% of the time, we probably always agree on a relative basis of, kind of what we think the best type of performing asset classes are going to be. We may not always agree on the specific return. But that is not going to be the most important piece of the puzzle when you're talking about your asset allocation. I think that's fair to say.
Yeah, relative
Generally speaking.
accuracy versus absolute, they're two completely different things.
Yeah.
John,
Yeah,
so on private equity, for instance, between the
Yeah.
75th and the max, it's a huge.
huge range there. Yes.
range versus-
Yep.
You think that might be a private equity manager who put that number in? Just saying.
No, that's what I'm that's what I'm wondering, so, I mean,
I would, Horizon, and I don't remember all the names here. I don't think there may be, I don't remember a lot of like specifics, say private equity managers. It tends to be more of, JP Morgan, who would sort of cover the waterfront and asset classes, or, a Vanguard or what have you. But somebody clearly has a dramatically different view than whoever, was at the very bottom of that range. It's a huge range. But I think, and this is why it's valuable for us to, look at a lot of these other capital market assumptions that we get. So by the time I'm getting to this type of stuff, we're having the conversation with RBK and we're running data, I've probably already read JP Morgan's and Morgan Stanley's and BlackRock's, and, at least at the summary level, maybe I haven't done all the details. So you have a sense of, what does the market broadly think? Is the market broadly moving away from core fixed income because yields are low? Are they, broadly, are your peers, moving more towards the private side because they believe there's more opportunity there? So, you bring all of that, kind of to bear. And we would not be, we're not going to RBK and saying, well, use the top of the range of all of these things. We're just saying, look, we've got 39 here, let's take the median or something and run that, because hopefully, 39 heads are better than one, or I guess it's, in this instance, we're looking at the 20-year horizon. There were only 24 that did that, but.
so I guess my question, part of it is too, is it's such a big gap, is it just one respondent that's causing that gap, or could
Yes.
it be?
In this instance, it is, right? So you can look at the yellow dot there is the 75th percentile, and the green dot is the max. So I would, there's probably not a lot that are clustered out by that green dot. I bet the rest of them are probably closer to the yellow. Although we don't know the exact numbers there, but.
I just think it makes them look optimistic.
It does. And you see some of those when you see, somebody putting a paper out and you look at it and say, boy, that's, pretty outside the norm, and maybe I don't, trust you as much as I did a minute ago if you're calling for stuff like that.
I think it's really interesting how clustered the inflation is. I mean, that obviously the market is finding that it's going to go down in 3 years.
Well, now this is 2021.
So
right?
this
So the
is- so this is not the-
2022 hasn't happened yet. We won't, Jim's just done his capital market assumptions. The 2022 survey will come out in August as they,
But this is
These
saying
were
this was
probably-
done in 20, but what they thought would happen for the next 20
These were
years.
probably generated between 12/31/20 and June of 2021. So inflation didn't start to kick up until after that.
But it was still what these analysts thought would happen in the next 20 years.
correct. Right. And interestingly, so I looked back, Horizon, they've got, this is just out on their website, and they've got all of the old ones. And the oldest one they had posted was 2012, where they had this. And I went and looked at inflation just because I was sort of curious, like, okay, what was, because when you look at, this actually ticked up 2020, the inflation projection was 2.1%. So it ticked up a little bit to 2.2 here as the median, sorry. But when I look back at 2012, it was 2.7% was the projection for the next 20 years. Well, clearly they were very wrong, at least for the first 10 or so, because
My 120
You know,
basis
other
points.
than very recent history here, we haven't had anything that's even really gotten to 2. So, you know,
Your
things
crystal
change
ball
over
is
time.
cracked.
That's why you're looking at this every year and.
You gained some ground this year, though.
Making up for lost time.
Making up some lost time.
You know, if
for
I
sure.
could mention one thing, he mentioned JP Morgan and Morgan Stanley. Our capital markets team actually has in-depth conversations with about 7 different entities that run multi-asset class products and therefore have to have an asset allocation in their product. They have to decide how much bond stock, whatever. And we compare methodologies and we compare views. And of them, we probably have more respect for JP Morgan than for any of them. And we don't waste our time talking to people who think that for 20 years, private equity is going to return 16% per year for 20 years. I wish that were true. But
One of the advantages we have here, I think, is we're a little bit removed from Wall Street and maybe groupthink. But when you're doing this, doesn't this put us back into groupthink where we can kind of do what everybody's doing? I mean, how do you get out so you can make your own individual? And you might be off on some of these.
Well, I think, you know, like we said, you're gonna be off on all these things because nobody predicts the future and.
Oh, and your evaluation, John, is always.
Always wrong, that's right.
It's already on there.
Dan puts it on there every year. Well, I think doing this type of stuff where, you know, having all of our people kind of do it independently first and give their opinion, looking at a lot of different opinions. And it's not to say that, you know, any of these are right or that we should necessarily use the median, but it's always interesting to look at the people that do have varying views. Now, maybe, you know, 15.3 on private equity is just so far outside believability that, you know, that's not going to carry much weight. But when you get, you know, maybe if I've got dramatically different views between, say, BlackRock and JPM, who are both pretty respectable entities, maybe that, you know, brings some questions to bear. And when we are talking to them, you know, we might query them about that type of stuff and try to understand why they believe, you know, dramatically different things in some instances. So you're right, it's a danger. But there is that kind of mean reverting aspect to capital market assumptions that, you know, you do always tend to think that things are going to get pulled back towards, you know, some longer term average, and you got to believe some things that, you know, you're getting an illiquidity premium, for instance, for private equity and things like that. And I guess if you saw, you know, I'd need to see evidence that that's not happening in order to, you know, want to dramatically change our asset allocation or, you know, do something different. I think the best example here of sort of recent years, and we did this over, I don't know, maybe 3 years or so, where we've cut a lot out of core fixed income going back, I don't know, 3 years ago or so. We were at 25% was sort of the not sure we even had a range at that point. That was the target, if you will. And we're now at 14. And I think this type of process was something that led us to that point and, you know, has turned out to be a good decision. But who knows what the future holds.
I think it's also important for John and for this board to know whether RBK as your advisor is at one of those extremes. You'd want to know that we are encouraging you to sort of bet the ranch on an asset class. And so, I mean, it's our obligation to do this crazy white paper and show you that our methodology is hopefully sound. But you still want to know, are you guys way off the market? And if you are, why? And so I think it's, you know, we have a lot of criticisms of the Horizon study structurally, but we have no objection to people looking at it, if only because it disciplines us that if we do differ tremendously in some direction, you know, John has a right to say, hey, what's up with RBK on X, Y, or Z asset class?
Okay. Any
Can I just ask a question? So Jim, in your inflation assumption, did you use more current data and have some of the elevated inflation in your estimates?
Yes, this is clearly dated. We had more current numbers to work with and more current analysis too about what were the drivers of inflation, because you remember that both the supply information on the supply chain constraints, but also on the effect of fiscal spending, those were new information. Remember, the Biden administration has thrown tremendous amounts of cash out into the marketplace. So
Everybody except me.
so depends on whether you're receiving it or paying for it, I guess, is how you feel about it. But the point is
I'm
that
not receiving it, but I'm paying for it.
the point is that our numbers are more up to date, and that's not a criticism of Horizon. This is just what's available.
Yeah.
But they're off in time. But one thing we didn't have when we struck our assumptions is the war in the Ukraine. And so the war in the Ukraine is having inflationary effects in a number of different ways, particularly food, but also energy. Food and energy have gone up very dramatically since the beginning of the war. And if it drags on for a long time, or sanctions essentially drag on for decades, who knows? We don't know that geopolitical events there's no regression to the mean in geopolitical events. So that we may have to readdress this inflation number again, simply because of those two fundamental factors, which no one knew about at the time we struck ours, even though ours are the most current that you're looking at.
So that 3-year deal is pretty much at risk.
Well, let's put it this way. Our capital markets team is spending a lot of time watching inflation here because, as I said before, an additional year or two of higher inflation changes the average inflation that you would have even over 20 years, particularly given how high it is right now.
Well, it have a dramatic effect on people's attitudes toward things too.
Oh my gosh, you have no idea.
Okay. Anything else? All right, let's take a break and come back at 10 after.
So coming back next week.
Yeah, I know.
Okay,
You ready?
yep. Don't be polite. I hate it
What?
when you're polite.
See, there's a reason you don't sit next to them. There'd be trouble.
All right, so tab, whatever it is, tab 7. Jason, Steve, you're back.
We used to call these deep dives, but given the transition, it's pretty shallow.
Yeah, we'll have to think of something else to call. I know the shallow dive doesn't.
Asset class review.
Asset class review.
Good afternoon, Mr. Chairman, members of the board. I'm Jason Brent, Director of Public Markets, along with my colleague, investment analyst, Steve Strong. And we are reviewing the domestic equities asset class, and I'll start on page 3, which shows some of the key elements of the investment policy for the asset class. First, the approved allocation range of 24 to 36%, the permitted investments, which is basically stocks, exchange traded funds, cash, as well as the key constraints. First would be the limit on our small cap exposure, as well as essentially a floor on the amount that we have in passive investments. Now, obviously, that's given the transition, 100% passive or well above that, and likely will be that forever, maybe.
So do we need to change that maybe?
We'll bring it to you if we feel like we need to. I don't know that critical one way or
No,
the
I'm
other, but-
really worried about
Keep them worried. Don't bring it to me.
You'll be gone, what do you?
And lastly, here, the asset class benchmark, the MSCI USA Investable Market Index, or IMI, which is an all cap benchmark. It has large caps, mid caps, small caps. And I guess if we want to go longer, we could have a tutorial. Steve would be glad to go into all the details of the construction of the IMI and moving on to slide 4. Again, the transition that we did last November, we are now at 100% indexed or passive investments. And the reasons that we discussed previously really were the efficiency of the US stock market, the ability to achieve significant cost savings, as well as more efficient use of our internal resources.
So on those cost savings, have the savings been what you expected? Or is it too early to tell?
No, we know what the expenses are going to be. We know the vehicles that we're in. They're not variable cost structures. They're fixed costs.
They're right where you thought they.
And
Based on the time that we've done it, was it a good idea?
I was hoping nobody would ask that question, but
Dan slipped it to me. I don't know.
No, I did. I didn't actually ask it either.
no, not knowing all the details, but some of the details, and to the general market environment, a big reversal towards value, away from the highest priced, highest valuation growth stocks. We were betting against the high priced growth stocks, and likely that has not worked in our favor, at least. But this is not a 1 quarter decision, not a 1 year decision. This is a multi-decade decision. But there were some fears too when we made the decision. Is the timing right? Like, when would it be right? Is that something that we have proven ability to determine when active management will be in favor or out of favor? And I didn't find any reason to say, well, let's wait. Let's try this in a year or two.
So you get calls from managers saying we told you so?
Gotten letters, emails. Just want to let you know our returns for the last trailing year, but no. No phone calls, nobody rubbing our nose in them, I guess. So back to the structure, we have 2 ways that we achieve passive investments. One would be the index funds, which we have separately managed accounts, which I'll describe a little bit later, some of the characteristics of these. Separate accounts for large caps, commingled fund for our small caps, as well as exchange traded funds, which is, think of it like a index fund that trades like a stock on an exchange. And we have several flavors of ETFs. We have all cap ETF, large cap ETFs, mid cap and small cap ETFs. And we can use that to more easily adjust our exposures to large cap and small cap. And I'll talk a little bit more about the benefits of each type. But,
Are you going to talk at that point about the benefits of using ETFs?
yes. So yeah, here on page 5, we'll talk about the different characteristics of these. So a separate account is basically a fund where we are the only investor, and we have that for our large cap index funds. It is the lowest cost option. We talked a little bit this morning about arrangements for securities lending in a separate account versus a commingled fund. The arrangement is better in a separate account than it would be in a commingled fund. And 2, we have the benefit of more frequent access to the holdings data. So for example, a separate account, we get daily holdings. For a commingled fund, typically it's monthly holdings. And so there's that benefit. So in commingled funds, which is currently, we have our small cap index exposure, index fund exposures in a commingled fund where we are invested along with other investors just like us. And in the past, I don't think we had the scale necessarily to have a small cap, to have a separate account. With the transition that we made, we have considerably more. I think we have the critical mass to look into creating a separate account for a small cap exposure. And we're currently working on that. And we'll get that done, I think, hopefully sometime maybe even before the next board meeting.
What's the critical mass?
What's that?
What was the number?
I don't know if we had a certain number. We had, back before the transition, we had maybe 150 million in the small cap index fund. I don't know if it's something we had really looked into in the past. Certainly we did, our large cap exposure used to be in commingled funds, and we transitioned those into separate accounts. But we currently have, over $1.5 billion in each of those. But now with 600 million or so or plus in the commingled fund, that's something we can do. And we'll get some cost savings too, and a better securities lending revenue split. And that's where the case of, say, for an active manager to go, we had with the DFA we were talking about in the commingled fund, the revenue split versus the separate account. With an active manager, it's obviously we like separate accounts, but it's not a huge driving factor, as opposed to an index fund where that makes a difference.
Why? I don't understand that, Jason. I'm sorry. I'm missing
Why is
something.
the difference?
Yeah,
So
why is it so much lower cost to have a separately managed account?
Well, in this case, I don't know. Our cost in the commingled fund has come down. And so I think the cost for the separate account will be the same.
Yeah, what we've been offered to have a separate account in a small cap index fund is identical fee wise to what we are currently paying for the commingled fund that we're in.
Okay.
But, and here's where the difference. So as I mentioned this morning, in a commingled fund, the arrangement is with the manager and the fund's custodian, not our custodian.
Yeah.
Which typically the split is not so favorable to us. Favorable to the manager, but not to us. In a separate account, we get to use our securities lending through our custodian, State Street, and our arrangement is much more favorable there. So that's for an index fund, that makes a difference. And that's something that we had, I don't know that we had ever thought we might be able to get into a small cap separate account, but it looks good.
Well, when you were talking, and correct me if I'm wrong, I understood you say in the larger cap separate account, there were lower fees to do a separate account than a commingled fund.
Yeah, and I think too, part of that too was just the fees in passive investing have continued to come down. I think that was part two of the negotiation that Randy had with the managers, was to get lower fees. And they were happy to do it.
Some of that's just our size call. So if you're in the commingled account, they pretty much have, they got to charge a fee, right? And they got to be, for the most part, I think, there's more fairness issues with, I've got to give the same approximate rate to people that are in this commingled account or in the separate account. I think they have more latitude within their sort of pricing system to say, well, okay, it's $1.5 billion, and that
we can cut a deal.
And if they give you that fee, they don't have to reveal it to the other players in the other investors in their mutual fund. So it becomes a one-time deal between the two of you.
Okay.
It doesn't affect their other business dealings where they feel they can get a higher fee.
Okay. But indexed in terms of the work that they're putting into it, if they're both indexed, right?
Well, yeah, I mean, you still have to rebalance the fund every single day.
Yeah, but I mean, we pay fees. We pay higher fees because it takes more work for the manager to invest that money wisely, right? So that's why I didn't understand why if they got two index funds, they're both indexed, why one would be lower than the other, but you explained it.
It has to do with the fact that there are other even smaller investors in the commingled fund that they don't want to cut the fee on.
Right. Yeah. Good.
Two, there's a benefit. On a separate account, we can trade the amounts we want.
What's that?
We can trade the amounts we want in a separate account. In some commingled funds, they have limits, so they're not, your trades aren't disadvantaging other investors by, demanding a large slice of cash out of the portfolio, which that cash drag can potentially harm the other investors. That's in a separate account. It's like, we want the money, we get it. And in any amount, basically.
You should like it. More lawyer fees.
Why?
Separate managed account, separate deal.
So ETFs.
So again, exchange traded fund or ETF, this is a vehicle that trades, it's an indexed vehicle. It's tracking an index, it trades like a stock on an exchange. The benefit that we have for using ETFs, a couple really would be, first is quicker access to liquidity than we would get in either a separate account or a commingled account index fund. So it kind of works like this. So if we want to either make a redemption or contribution to an index fund, we notify them today, and typically they would trade as of the market closing price on the following day. With an ETF, we can trade in real time. And that can be, there's a convenience factor there. And two, with ETFs, we can more easily and more quickly adjust any exposure we want particularly with small caps. We can use it to do that as well. But that's one of the things we mentioned in the last couple of board meetings, how we have a new process for trading ETFs where we use Bloomberg system to put brokers in competition to get best execution, best pricing on ETFs. And so that's worked very well in what we've done so far there.
Now, ETFs don't have to be indexed. They're active
No,
ETFs.
there's more ETFs than our stock, right? But the ones we have are tracking, and like I said, we've got an all cap ETF, large cap, small cap ETFs, big cap. So these are things we can use to dial up or down the exposures as we want.
You already covered this, but ETFs have an internal operating cost too, right?
Right.
So how does that compare to index, non-ETF index funds?
The cost it depends on the ETF. Our large cap, well, everything except the small cap ETF is more expensive, but very cheap.
Yeah, I figured, but I just wondered, because if it were a retail person, there's a commission, but it's not going back to the people that are managing, they're not managing the fund, but they're having to do the balancing and rebalancing, right? So to be the same cost, if it's an index fund or if it's an ETF, it doesn't really matter to the person who's doing the rebalancing, right? I guess for the cost should be about the same, except you've got the 1 day turnaround, which will.
Some of it depends on the pricing of the ETF, which doesn't necessarily match with what you're getting
That's
through.
right, because it's not mark to market, it's what it's trading at, right?
And so you have well, say for our large cap ETF, which tracks to S&P 500, it's three basis points. Wow, so it's cheap.
So are we parking money there that we were gonna eventually put someplace else, or that we need, or as we're counting it as instant liquidity, or are we long-term investing in ETFs?
It's
Or is
not
that
necessarily-
not even a
not necessarily
dichotomy?
parking money that we're going to use to deploy to other areas necessarily. But it's one of the things when we looked at the transition, it's like we want enough to be able to move our exposures by a small amount, a couple percent maybe at any one point in time. And so we want this amount in large caps ETF and this much in small cap ETF to be able to do that. Say, if we want to change by our allocation by 1% or so, we could do it. But to not have more than that, because it is, I mean, it is very cheap, but it is more expensive than our index funds. And so we went that.
So it's a vehicle for rebalancing? Is that a fair
As
way
well
to put
as,
it?
as well as liquidity. There are some times where we might be less patient. We want to trade on a certain day. And we can do it through ETFs as opposed to having to wait. And now in some cases, if we wanted to press on the index fund manager, we could get it, potentially get same day trade value, but really that's the 1 day lag, and the notification of the trade date is standard for what we're dealing with.
Yeah.
With our index fund managers.
Give you the example that, you know, hopefully doesn't really happen, but you know, something happens where we get a private equity call that we didn't realize was coming. That shouldn't happen, but once in a blue moon, we've had something, you know, pickup happens and, oh man, I need $50 million today. I can go to Jason and say, sell that. I need 50 million. We got to put it into private equity and it needs to go out the door to meet this capital call. I can't really do that with a separate account. It'd be more difficult with the separate accounts to make that happen. So we probably do that, something like that with the ETF. So we want to have a little bit of that flexibility.
No, I get it. That's interesting. Thank you.
Any other questions? Otherwise, I'll turn it over to Steve.
All righty, we are on page 6. Talking about tracking error, which simply stated measures the difference between the investment's return and the benchmark's return. Now, if we're talking about an actively managed account, which we still have on the international side, the objective that we would specify for those managers is we want you to outperform the benchmark over a multi-year period, or you know, something to that effect. So the goal with an active manager, if we can call it that, is to produce tracking error. Now, hopefully it's positive tracking error. If it's negative tracking error over too long of a period of time, we might look for a different manager. But that's the stated goal that an active manager would have, is to outperform the benchmark. The stated goal of an index manager is not that. It is basically to minimize tracking error. Basically, we are trying to get beta. We're trying to get market exposure. And so we don't want you taking outrageous bets with an index fund to see if you can beat the benchmark. That's not the goal of an index fund. So therefore we try to minimize tracking error. Now, what causes tracking error for a manager? On a net basis, certainly management fees, we do have to pay them, or even in the case of an ETF, as we said, there's, you know, a fee involved with those. So that's something that goes into it. Securities lending, this keeps coming up. Now, this is ideally a relatively low risk way to boost your returns a little bit without taking risk in terms of buying stocks that aren't in the benchmark or taking different weights in stocks or things of that nature. So basically we have these stocks already because they're part of the benchmark. So therefore the index manager owns them, but we can lend those out, and, you know, going through the flow chart and all that stuff, eventually you get to where, yeah, you get a little bit of goose to your return from that. So sec lending tends to be a positive. Securities litigation, again, tends to be a positive. We don't deal, you know, internally, we don't handle the litigation. We have outside parties that do that, or have the custodian assist with that. But there are cases where there might be a class action suit against some company that's a member of the index and they have to pay out. And so again, that's something that boosts your returns a little bit. Securities misweights can be positive or negative. In the case, for example, of the large cap separately managed account that we have that tracks the MSCI USA. It is what we call full replication. So BlackRock and Northern Trust, the managers of those accounts, attempt to own everything that the index actually holds in the actual weight that the index holds. So again, that's gonna, in that case, your miss weights will be minimal and the plus or minus from performance standpoint would be very minimal. For small cap funds, technically everything in the index is investable, but some of it is more investable than others. In particular, when you get to the really small positions out in the tails, you may run into some liquidity issues and whatnot with that. So what would happen in that case is the manager would do what they would call optimizing. So they may not actually own every single position in the actual weight. They will own possibly a larger amount of another benchmark component that's more easily traded that has similar characteristics in terms of market cap or PE or what have you. Basically, they'll find another way to replicate that exposure without having it 100% the same. So as I say, that's more common in small cap than it is in large cap and could produce slight positive or negative tracking error. And again, the idea there is not specifically to generate tracking error. It's to produce a portfolio that you can actually trade in real life, but the manager has to figure out a way to make that actually viable. And so that's why you might get slight securities misweights. Allocation tracking error is that's something that we can effectively introduce from our standpoint. As Jason mentioned, we have certain index funds or ETFs that mimic the entire market cap universe from small to large. We also have some that mimic only the large cap or only the small cap portion of that. So if we have a view toward whether we think smalls or large might do better than the other, we can allocate more capital to the large or the small cap portion of that spectrum. So that's a decision we can make that would introduce tracking error, but it's more of an active decision on our part. So that's not a decision that the index manager would make. It's one that we would make if we say, okay, we believe in small caps, we're going to put more into that than what the index, than what the actual universe is from large to small. So we would have a little bit more here, a little bit more here, whichever way we want to do it. So that's, again, a tracking error that we may choose to introduce if we so desire, as opposed to things that are more a function of the investment process itself.
Do we do that?
Yes, we do. And in fact, we've got some charts coming up here, and I'm going to show you some stuff on FactSet where you'll be able to see that as well. But that is something. On page 7, just real briefly on due diligence and research. So we've shown in the past some of the things that we do in terms of evaluating active managers. They have investment guidelines, they have scorecards where we track their performance and staff changes over time. We do quarterly reviews with them, analysis using FactSet, visiting them on site. We actually do all of that same stuff even with our separately managed and in most cases, our index funds as well. We don't do that with an ETF manager because it's more of a retail product, but we do that with primarily BlackRock and Northern Trust, being as there are basically where we have the vast majority of our passive dollars. So we don't want to, give the implication that, well, because it's a passive fund, we don't have to pay attention to it. That's not the case at all. We apply every bit as much diligence to a passive manager as we would to an active manager. And in fact, we're starting up just this week on calls with all of those managers yet again. So no difference there. Tools, again, FactSet I've got right here in front of me. I'm going to screen share that for you guys in just a minute. Bloomberg, so we have an interesting platform through Bloomberg where we can put brokers in competition with each other, even for things like ETF trades. So we can try to get the lowest cost we can, even on trades by that. Competition is obviously good. Competition is good even in the passive space, so we can figure out the way to get the lowest cost there. eVestment is a manager research platform that I think we've showed that to you a little bit in the past. I'm not going to look at it today, but basically, if we're looking for managers in any given space, we can pull in a number of managers that kind of are competitors of each other, compare fees, compare performance. You can do that with passive managers just the same. And finally, online trading platforms. So basically, we used to have to either call up the manager or even sometimes, really old school, send a fax or something like that to say, hey, we want to, redeem X and such out of this fund. So with both BlackRock and Northern Trust, we can actually just do that right through their websites. Now we can just say, go in and initiate the transfers that we want to do there. So basically, saving steps, saving time, saving costs, just by using platforms that they've set up for us to use. So that all works out really well.
As archaic as you think the fax machine is, we're using it relatively recently.
Yeah.
And it was not.
You're saving $40 a month by not using it.
That cost reduction plus it's a matter of 4 or 5 clicks and we've submitted an order, which then goes through our compliance department. So operations will approve the trade and we'll go in. So automatically that way. It's much better than the old way.
So flipping over to page 8, just a couple of real brief charts here. We've talked about the different sorts of vehicles we have. Here you can see what the actual current breakdown of those vehicles is. The vast majority of it is in separately managed accounts at BlackRock and Northern Trust. The commingled index funds are all currently housed at BlackRock, and the ETFs are primarily, again, they're in a sense a retail product. It's not something where we have to go and sign an account or sign a contract with the manager in order to buy and sell those. They are primarily iShares vehicles, which again are BlackRock constructed vehicles. But just to kind of give you a sense of what our profile looks like in terms of, okay, you say you have all these funds, what do they actually look like? One thing that I would point out, and this kind of goes back to tracking error, is the separate account index funds and the commingled index funds are going to, for the most part, subject to the optimization discussion we had before, are going to hold the same exact components as our benchmark, which is the for the asset class level is the MSCI USA IMI, which means it includes funds from large cap or stocks from large cap to small cap. So the commingled index funds and the separate account funds are going to be very close on that. The ETFs we hold may vary to some extent. Not a lot, but a little bit in terms of what they hold. As Jason mentioned, we have an S&P 500, which is a large cap ETF. Part of the reason for that is the availability of a portfolio or an ETF that would exactly mimic the MSCI USA is limited in availability, whereas the S&P 500 ETFs are very easily available, easy to trade, cheap. But the S&P 500, its holdings are going to differ slightly from what the MSCI index fund holds. So again, that's a place because of slight differences in holdings versus what our official benchmark is that you might see a little bit of tracking error. So just a point to bring up.
Ideally, we'd like to have the components of the MSCI USA IMI and ETFs, but 2 things. It's got to be liquid, and the MSCI USA ETFs are not nearly as liquid, at least we haven't found one. And 2, the cost. It's got to be cheap. So that's why we have what we
So it's
And
slightly
cheap
different, but
is-
not significantly.
Cheap is what range?
As cheap as you can get. So like I mentioned with the S&P 500 ETF at 3 basis points. I don't think there's anything cheaper than that.
We looked at an MSCI one, large cap or something, and it was way more.
Yeah, I'd have to look
And
and
not
see if
nearly,
there,
and not nearly as liquid.
it could potentially be like a Russell 1000 ETF.
Yeah.
It might be cheap.
And what, and the one you looked, I mean,
We looked
just
at
give me a
bunch.
number. I mean, it just doesn't have to be
In terms of the cost.
when
of
you
some of
say
the
it
other
was
ones.
more expensive than that. Is it 10 or was it 50 or was it?
15 or 20 or
15
something
or
like
20.
that. It's in my mind, but I don't know if that's.
Yeah.
Okay.
So that's 5 times more expensive.
Well, I understand. Yeah, 15 is 5 times 3. I get that.
Now you ask. Now you ask.
On the international side, we traded one that was 60 basis points for one that was 11. Yeah.
You're back, that's the 5, you're almost at 5.
A little bit different exposures, but the cost was a bigger deal.
So essentially, you're saying the extra tracking year is worth it.
Absolutely.
Just going back to one thing in terms of talking about tracking error. This project, at least we've been working on with commingled small cap funds in a separate account. So you have, the fees are a drag on returns. The securities lending, litigation, that is a boost to returns that ideally we might outperform the index over long periods of time by small amounts. But you're concerned not just with the management fee, but the all-in total return or all cost, which could be a benefit to us. That was part of the exercise Steve went through, analyzing all the potential, amounts of securities lending we might do and what the arrangement might be and what that revenue means to us. And that analysis, like, yeah, it makes sense. We should do a small separate account.
Okay. Page 9, just real briefly, kind of shows you, and Carl, this goes to your question of, do we do that? Yes, we do. So you can see there that we are about 3% overweight in small cap versus large cap. How we define large versus small is we try to do it basically the same way the index does. So every 6 months, and we've talked about this in other presentations, but briefly, every 6 months, MSCI reviews the entire investable universe and says, okay, here is where we want the market cap break to be, some numerical market cap value between what constitutes a large cap versus a small cap. On a global basis, the idea is that large caps would represent approximately 85% of the universe and small caps represent approximately 15%. As you can see here for the benchmark, when you actually look at that, it varies a little bit by country because the US is so mega cap focused. Our weight towards large caps in this country tends to be a little bit more, but ideally that's what they're shooting for. And so basically we just go out and we take that same, whatever that numerical market cap number is, and we apply that to our own portfolio and say anything that's below that is characterized as a small cap. Anything that's above that is characterized as a large cap. That's how we determine what the light blue bar is on here. And the dark blue bar is basically just what MSCI tells us it is. Page 10, just real briefly. This is, a chart from the board book. This is as of 12/31 because we didn't have the March end numbers when we saw this, but basically, absolute returns have been pretty gangbusters for quite a long period of time. Relative returns were more of a drag over the long term, which I guess kind of goes to, why did we make the decision to go from a mix of active and passive to all passive? That's kind of it right there. And I am supposed to be able to share my screen, so I'm going to attempt to do that, and I'll just run you through a couple things real briefly here. Actually, if I can get my menu to come up, it doesn't want to cooperate. Of course not.
Lindsay, I don't know how to do this.
I can do it from here, I think.
Okay.
I've got a share screen, so I'm gonna
You're
try.
not just gonna yell at them.
Oh, I leave that to Dan.
They missed it when I was gone.
I did it once in a while just to kind of keep her. on
Yeah,
her
I'm
toes.
sure Lindsay would tell us that she missed it when you were gone.
There we go. All right, cool, we got it. All
Okay,
right, so this is, you know, same kind of thing that I've showed you in the past. Basically, I've got it pulled up. This is a report that consolidates all of our domestic exposures. So whether it's the separately managed accounts, whether it's the commingled funds, and with the ETFs, we basically just essentially we create our own look through. So we say if the ETF holds the S&P 500, then we're just going to map the contents of the S&P 500 in that dollar, in the dollar amount that we hold that ETF. So that's how we get to this point. So this is for Q1. So this is going to be subsequent to changing to passive. And when we do attribution in here, you know, it's off a slight amount. You know, here it shows that we underperformed by a basis point. We actually slightly outperformed for the quarter in domestics, but it's pretty close. But going to the idea of tracking error, we actually want to see a number that's pretty small here. So there would be slight differences. So we're looking at it on a sector basis, and so you can see the total effect, for example, right here for communication services is a slight positive of 3 basis points. For healthcare, it's a slight negative of 6 basis points. And again, that kind of goes to, as I mentioned, the ETFs might hold slightly different stocks than what our actual benchmark does, but it pretty much works itself out in the end. So here I'm going to switch over to market cap breakdown. So here, this is pretty straightforward. So large is again what the number is above whatever that market cap break is. Small is below whatever that is. The individual managers hold small amounts of cash, and we also hold a small amount at the asset class level in the STIF. That is all captured in cash. Certain managers, the index funds in particular, use a certain amount of futures for equitizing cash positions and so on and so forth. So what you will see here is, because we were overweight small cap, so on average for the quarter, we had 13.4% in small cap. On average, the benchmark had 10%. That worked against us because of small caps performing worse than large caps, but we kind of got that back in those slight differences in composition. But this is where you can see, do we make a choice like that? Yes, we do. So it didn't work out for us in the quarter, but we're investing for the long term. And so that's how I'm going to frame that. But you can see that we can actually look at, on pretty much a real-time basis and say, hey, how is our decision to overweight small caps? How is that working out for us? So we actually have, even, with FactSet can do even that. So even with a passive fund, there's lots of stuff we can do with it. I could show you various other charts, but in the context of a passive fund, they probably wouldn't be as exciting. So.
Yeah, this has been real exciting.
So I will leave it. I will unshare my screen before I get myself in trouble, and leave it to any questions that you might have.
Questions? Comments? Suggestions? What can I say, guys?
Works for me.
Yeah. Thank you.
Thank you. Appreciate it.
Thanks. Recap? We had any? I don't think we have any recap.
No recap, busy May. We'll review the buildings as an investment with the new IRRs for the year. Peggy ran them the other day. They're phenomenal. So all good news on that front. Do the investment policy statement review in May, as well as the real estate I think that's still a deep dive as opposed to a shallow swim. Deep dive. Budget status, fiscal year to date, quarterly reports for investments, the loan portfolio, the intercap, as well as it's an HR heavy meeting. We do staffing level review, accounting review, and exec comp review. So big May meeting.
Get plenty of sleep.
Yeah.
A lot of loans too.
And we've got 3 loans coming. We'll have ARPA update, most likely have new program details from the governor's office. We'll have the section 10 and section 70 portions of the policy manual for adoption. So it'll be a big one.
You sure you want to miss
Yeah. He looked at the 2-dayers and was like, I gotta go.
No. I dropped the one. Well, I've already explained to Dan. I'm not in charge. Well, with that, unless there's anything else, we are adjourned.